Man, this OBS crap. Total frustration from this thing. OBS is what I use to. By the way, good morning. The, the software that I use to try to stream this crap to YouTube is not working with me today, so I'm trying to figure out if I can get the audio captured here. Give me a second. And audio check. Audio check. Okay. Now I can hear. So anyway, good morning. Sorry for my delay here. It's technology for you. The NASDAQ here has had its high impact news driver release at 8:30, and then they've pumped it up into the new week opening gap at on July 28th, 2024, and we have a 15-second chart on the right, and then we have the 1 minute chart in the lower left, and upper left we have the 15-minute time frame. So I'm a little jerked out of gear because of my actually not opening up like I wanted it to. So give me a few minutes to get my bearings here. An old Navy term my grandpa used to use. My bearings. Let's peel through this with the 1 minute chart. This line here is the close and the opening basically being the same price at 5 p.m. yesterday evening, New York time, and 6 p.m.'s opening price. So if you recall yesterday, I was mentioning how if it was going to continue, it was going to trade up into a new opening gap here on July 28th. And if it continued higher than that, we had some daily short-term high and a volume imbalance that was further back in the year. This was pretty aggressive here, opening on our high impact news driver at 8:30 and sending it up, and finally bumping that old new week opening gap on the 28th. All right, so we had several highs in here swept into a old new week opening gap. I'm going to be watching. Does I'm going to use this information here with that gap and maybe use a wick into this one between this candle's low and this candle's high. Now, I was going to talk to you a few days, I think it was last week, I was going to talk to you about wicks. But I never got to it because the stream got interrupted with the remnants of Hurricane Debbie. So whenever there's a wick, I like to see it try to trade back down to the midpoint. If it doesn't get to the midpoint, it's like a fair value gap that can't trade to its consequent encouragement. So it's usually indicative that it wants to go the other direction. Because it didn't trade there, and we have done somewhat of a nice smooth area in here, this high, and then they ran up into the new week opening gap. I'm watching during the opening range, which is the 30 minutes after 9:30 to 10 o'clock. Do they want to send it up in here or into that? Because if there's two fair value gaps, this is the one you're watching, but you have to make an allowance for it to trade up into there. And if it does want to sell off, I want to see it try to trade down to here. I'm not trying to call the top. I'm not trying to pick the top. I'm not trying to force an opinion. I'm observing and seeing if it wants to provide that information to me. And the main focus today is turtle soup, by the way. I just want to get a read on what it's doing here going into the 10 o'clock hour. I hate to have to do all that kind of stuff. It gets on my nerves too, but all these people out there trying to be me to get engagements for ad revenue or whatever it is they do. Let's do this. To the fellow that says make the borders opaque, I want to see the borders. I want to see what the actual candlestick wicks are traded to. So if I don't use the borders, they won't really technically be accurate. So you're getting a chance to see what it's like when I'm jerked out of gear, because I was fighting with this OBS thing for like 20 minutes. It wasn't syncing with the microphone. It wasn't giving me any audio connection at all. I had to keep restarting the system. And I don't know. They had an update, and I chose to use the update. And I always tell myself not to do that. And it wasn't working, so it took several times to do it. Now I'm a little pissed off, to be honest with you, because I come here later than I wanted to be. All right, so we swept down below the close and the opening price at 6 p.m. Since there's really no technical gap or difference between the two prices, I always just use a simple little line like that. Okay, and I treat it the same way. They can sweep through it, come back and revisit it. It's one single level. It's not a range or an inefficiency. It's just one single price level. So you can see we had this candle here trade to 131.50. High here 131.25. 131 even. So just fell short of touching that gap there. I was talking about, I think it was yesterday or the previous session where I was referring to. Oh, yeah, it was yesterday. Yeah, it was yesterday when I was talking about the lowest barrier to entry. The easiest entry points are going to be the ones that you don't try to finesse too much. And if you're trying to use one tick above to get any kind of short in that fair value gap there, you wouldn't have been filled. And that's the punishment for trying to be too perfect, trying to demand perfection, which is a good problem because most people can't even figure out what to do in terms of direction. They can't figure out how to get into a trade. So if you have a problem with not getting filled on some of your trades, or initially if you're trying to demand too much perfection, that's actually really good. It's a nice problem to have. It's so much better to tolerate a repeated phenomenon of you trying to do something that obviously is on the side. That means you're correct in where you think the market's going to go, versus not knowing what you're doing and always getting it wrong. So it's a little bit more palatable. It's easier to sleep at night knowing that you're on the right side generally. But I got people, sending me emails and reaching out to me through Telegram, and reaching out to me through TradingView, and reaching out to me through personal text messages, which is that annoys me. I told everybody I was going to change my phone number last year when I got to this year, and I haven't done it yet because I just haven't made my way to do it. But it's just too many people, they take it upon themselves to feel like they can text me like we're best friends. And I generally don't like that unless I reached out to you or gave you permission. So we traded down to the consequent encroachment of the wick as we were looking for. The only difference, and the notable thing is we didn't trade up into the gap. We got real close to it within a tick's distance within the delivery of price. Okay, so I want you to screenshot that and make special notation in your journal how this is what we were watching. We wanted to see if you could trade up into it. It did not trade into it, but the idea of trading down to the consequent encroachment of that wick, it was the draw that we saw price reach for. And now I want to see, do we keep a do we have the ability to stay right there with the bodies, or do we explore to the lower quadrant on that wick? Now the wicks are going to be part of the conversation today when it comes to turtle soup, as you'll see. All right, so here's the opening price on that wick, all the way down. So we're looking at the actual news candle. So at 8:30, there's going to be a lot of inefficiencies in that individual candle, meaning that where we opened, it ran down aggressively real fast, and we'll look at that on a sub 1 minute chart in a few minutes. But for now, this inefficiency where price is here, and then in a few moments, I watched it deliver this morning. It was wild. It wicked real fast, went down there, and did not spend much time at all, and right back up into where we are here in the body, and did its business going into the close of that individual candle for 1 minute. Meaning that there is inefficiencies all through this range from the candles open to the low. And again, that'll make much more sense to you when I show you the less than 1 minute charts. So in other words, the 30-second chart, the 15-second, 5, and 1 second chart. But the first rule of engagement, whenever there's a wick, and if it's a swing high or a swing low that has my interest. Obviously, this is where the damage was done this morning. Anyone that was long going into the 8:30 news driver, the high impact news, and maybe we're holding on to the targets we were outlining yesterday, the new week opening gap on the July 28th. We mentioned that yesterday as a continuation. On the upside, should it reach for further higher prices, this is one of those levels it could reach for. But before it goes there, it trades aggressively, drops down over 100 handles or so, and then eventually pegs that level. This drop down is inefficient, but every single time there's a wick, and it's part of a swing high or a swing low that has any importance to me, technically, I'm interested in having the consequent encouragement level annotated, as you can see here. Now, I don't know where you're from. I don't know what school of thought you're predominantly a part of. I don't know if you're here because you just out of mere curiosity and you trade another methodology, or if you trade the stuff I teach. But that to me, and turning like that, is significant, and it tends to happen all the time. This is a 1 minute chart. So the question is when you see that, does it invite you to investigate more details around it? Because that's what it started to do with me in the 90s. I was looking at these things happening, and I'm like, okay, it's probably going to go down below that low. Well, sometimes it doesn't do that. So I was going back through charts and looking at different time frames. Using Metastock was my software program back then, and I was using end of day data. So I didn't have real time data, but I could go down into intraday charts. But it was part of an end of day package of data. So I would look at hourly charts and 15-minute charts, and it would give me like an X-ray view of what took place in the previous day. So I compared and contrasted what I was watching when I was driving around in a truck delivering candy, soda machine items, coffee machines, cold food machines. That was what I was doing at the time when I was learning how to trade in the 90s. So I fixed and repaired and serviced vending machines. And I had this little device called Quotrek. And if you've been around for a long time like me, you know exactly what I'm talking about, but it was kind of like a little radio. It's about the size of a transistor radio, not as thick, but it had a little extendable antenna. And it would give you data on any markets that you're subscribed to. You know, CBOT, Chicago Board of Trade, Chicago Mercantile Exchange, any of the grain markets that would be on CBOT. I'd be watching them. I'd watch the grain and the meat markets, and I would watch the currency futures. And eventually moved away from that and started watching predominantly the bonds and then the S&P. So it would give me the details that I would see these flashes in price action that would just be numeric. It doesn't give you a chart, or rather, it did not give you a chart. The technology really, I guess, wasn't there yet, so they just gave you the raw data, which was the highest high and the lowest low and where you're at in the volume. And I've said this before, so it's kind of like redundant for folks who've been around long enough. That was what I was doing when I was away, where we have a smartphone today. So if I'm out and about, or if you're out and about and you're not in your trade room or office, you can see what the charts are showing and where the price has been and where it's probably going to reach for, because you can see it visually. So I was kind of handicapped initially. So when I saw big runs take off, I would write down, usually on a paper towel that I would use to wipe down the inside of my windshield or whatever. You should have saw this. It was wild. I was not organized in the beginning because my job and keeping my job was the most important thing, but I was still trying to manage all this stuff and watch it real time, the closest thing I can be tapped into this. And when I would see price runs start taking off, and I'd think, okay, it's occurring right now at 10:49, okay, or 9:36, and I would write the time when I noticed it by the numeric run-in price. So in other words, when it started taking off, I didn't have any visual representation of that, except for I know I saw a price print numerically. I mean, in other words, it would say this price here, 19,048 in the quarter, and then it would fluctuate as it's moving here. So if I see these runs, I make a notation, or made a notation, and when I got home in the evening time, after working out, getting a shower, eating, and then the rest of the night, I'd be out in the charts constantly, pouring into it and trying to look for these types of things. What made that run like that? And I would see certain things, and sometimes, not all the time, sometimes there would be these long wicks. Now this is exaggerated because it's a high impact news driver. It goes without saying that PPI, CPI, FOMC, non-farm payroll, those types of reports or those types of data points that are released in the marketplace can create that formation of this type of move. When it creates this and it starts to rally up, I've never seen anybody, and I have over 2,000 books, I've never seen anybody make reference to anything about going back into the middle of this wick or break it up into quadrants and use it for the purposes of for reversal patterns or short-term trading or anticipating it returning back to it for the sake of a target. Okay, so it was exciting for me to see it, and as you watch this one pan out here, you know, from here to here, that was the observation. So Caleb, when you see this, I want you to annotate how it did not trade up into the opportunity for you to get filled, but it still ran. And then I want to see what your description of that run is in your own terms. I don't want to say anything more, but I want to kind of correct it if it's not what I think is appropriate, and if it's right or if it's in the right perspective, then obviously I'll commend you for it. But the market trades back up. What's it trade back up? Remember I told you what this line was? If you missed it, if you came to the stream later, you just signed into it. Yesterday at 5 p.m. when we closed the settlement price, and then when we opened up at 6 p.m., there's no difference in between those two prices. So there's no gap. So all I do is annotate that price because it'll still refer to it. And as you can see, we trade back up in. Where's it trading into also? What other confluence is there? Look close. There's two other things there. You have that gap, and then you have what I'm discussing here. Whenever you have wicks, you want to measure that. Okay, here's the halfway point or consequent encroachment. This wick is allowed to go through it. Why? Because you have a fair value gap. But then look at this one here. What's the high of that? You're going to look right over here. Look up in the upper left-hand corner. What's the high of that candle right there? 19,096.50. That's exactly the consequent encroachment level of that wick. You're going to tell me that that's buying and selling pressure? Yeah. So when you're looking for entry patterns, when you're looking for targets for limiting out on partials or terminus, here's your 3/4 level traded to. Now, because of this, I want to see it respect this up close candle. In other words, don't trade above it. It can come back and touch it again. It's better if it doesn't and leaves a little portion here. But I want to see it to explore now below this 830 news driver. That's what I like to see. But here, this wick trades up to cutting through candles because it's not supply and demand. We go right back to this wick right here. That candle's high to the tick gives us the actual high that you can anticipate as it's returning back into here. Why should that be reasonable? Two things. Number one, you have this wick here. Bear with me. I have to put the lipstick on this chart to show you what I want to see illustrated. When I was working on this information, figuring it all out, codifying everything, and discovering a lot of things that really wasn't in my books. What did I just no. Didn't I just draw a line there? It's disappearing. Oh, I know what I did. I have the color. All right, so that's going to go on that candle there, and it needs to go to the 50 level. 96.50. 96.50. All right, so now I can take that off, and you can see that that's anchored to here. So this is what you want to be doing, Caleb. You don't want to be leaving your Fibonacci's on top of the wicks because it'll clutter up your chart. It'll make me angry. And it's also, you just don't want to have all that information on there. It's not important to have all that. Let me put this down here. So some people are like still trying to put my stuff on their social medias and pretend that they're me. So we have this wick here. We have this gap. It trades up to there. And also, what's to the left of this candle? The one that trades into the fair value gap, right? So isn't there a wick on this candle? Sure it is. So we have this wick on this candle inside of this fair value gap and this wick here. So when price was trading off of this target we were looking for and it rebounded off that, came back up into the fair value gap, it's reasonable for it to go up to the fair value gap high, which is this candle's low. This price right there on that wick, it's a premium array because you're trading back up to it. You extend that through, it's part of the fair value gap, and then the next candle trades up and touches it. We do not want to see, this is important, we do not want to see, if it's going to be bearish, we don't want to see that consequent encouragement of that wick. Once it's traded to here, once it trades back up to it there, we have this fair value gap that should send price lower or kind of keep it at bay, not trading it higher. So if this candle is trading back up to it, we are trusting the logic around this phenomenon saying that it's already done the work of trading to the high of the fair value gap. So half of the fair value gap, let's look at that. You can see it in here. It doesn't trade there. Notice that on this candle? It does not trade there. Is that a good thing or is that a bad thing? Think about what I've taught you. In this mentorship, I taught you that PD arrays, very specific levels that we're looking for, if they fail to be printed to, if they can't even return back to them, and you have a directional bias in concert with that level you're studying, if it can't go there, that means it's decidedly weak. And when you're bearish, that's a signature you want to see. But because we have this area over here, and because I'm not trading support and resistance, the support and resistance fellows would have been like, okay, here's where we stopped. So let's draw that line out in time. Well, we went way past that. Just some random up closed candle and created a wick, something random. We don't know why it went there, right? Support and resistance folks don't have any idea why it did that, but you're learning it. It's this wick here. It trades up to it, completes and fulfills the role of buy-side delivery, which was inefficient on this candle. So the market has offered single pass to the downside, so this is sell-side delivery. That means price is going lower. Then it comes back up to re-deliver the inefficiency in this time of that one candle. What was it inefficient on? Delivery to the upside. So buy-side delivery. It offers it, stops to the tick, and then drops down. The next candle, if you're looking for support, if you're looking for swing highs and swing lows, you want to see it trade up into levels like this. It should hit that and stop. And also fail to trade to half of that fair value gap. That's a failure to get to consequent encouragement. We've already fulfilled 3 factors here. We traded up to finish in filling out this candle's low to the difference of this candle's high, which is that fair value gap right there. That's a SIBI, sell side imbalance, buy side inefficiency. We trade back to the 6 p.m. opening price. Why is that important? Because there's no gap between Friday, the 5 p.m. close settlement price and where we started trading for NQ. So because there's no gap, we just simply use the 6 p.m. opening price. I told you when we were up here, you're going to have it on your chart because it's going to be treated the same way. It'll trade through it and come back and treat it as a key level. It trades through it on a wick, which is reasonable because we're inside this fair value gap. But this level here, when we trade it back up to it, notice that the bodies in the candles do not trade and close above that wick. Consequent encouragement. See that? It's telling you that this candle backed off. So that means when I see something like that, I'm looking for the immediate next candle to do a lower high than this high. And I can frame everything on that fair value gap and where that consequent encouragement is on that wick, if it's there. You may not have a wick over here. Then you would just simply go into the details of simply using the 6 p.m. opening price, which is this dashed line, and the consequent encroachment of that fair value gap. So in other words, if this wasn't here, I would expect this to trade up to midpoint of the fair value gap. But if it doesn't and it trades down lower, I'll simply just go in short on the open and touching back this body right here, as it does there. So, and that could be easily done on a 15-second chart, a 30-second chart, a 5-second chart. You would see a little bit more detail in that difference between where we close on this 1 minute candle to where we open there. And I know some of you, because you're leaving comments saying that you don't have the ability to afford the real-time data. I got to be honest with you, at some degree, you're going to have to do that. If you're going to trade, you have to have the information. And I don't know how to say it any nicer than if you can't afford data and watching real-time price action, a lot of the things I'm teaching are going to just simply be outside your grasp, and you're going to have to use a higher time frame premise. And there's nothing wrong with that. It just means that you're going to have to defer these very small intraday price action moves. But all the things I'm teaching here, this could simply just be a daily chart. In other words, instead of 1 minute candlesticks and this representing the highest high, the lowest low, and where it started and ended trading for that 1 minute interval, these could represent a daily high, low, and open and close for the day. It's the same stuff. Don't think it only works on 1 minute charts or intraday charts. That's not it. These levels will be referred to on any and every time frame. If I was watching price over the NQ and we had the time frame set to 4-hour chart, price right now at 41.75 is the same price you'd see it on a 4-hour chart. Price is price. But if you're looking for details, for precision, you want to look for very sensitive timing so it gets you into a trade and or reduce the measure of risk. You're always going to have risk, but you can reduce the risk and manage it appropriately by having intraday charts, because you can see details in price action that otherwise you're not aware of. Okay, and that's kind of like why I was tapping into the memory of how it was for me when I was driving around in a Isuzu cargo truck, delivering candy, soda, cakes, and chips, and coffee products, and cold food and ice creams. I was looking at just simply data, and I had to later on go back in and remember my notations as I was driving. Sometimes I missed it, and I had to figure out, okay, well, I was in traffic. I'm trying to get around this guy or get around that part of town, and I couldn't look at the data, even though it's right in front of me, duct taped on my windshield. So it was like a hillbilly version of a ICT, right? I mean, you're all impressed with the NASA spread out of all my monitors and stuff I shared on YouTube. But back then, I didn't start like that. I had literally like this little transistor radio type thing physically duct taped to make sure it stayed in my view and it wouldn't fall and break. But I had to take the notations and say, okay, I don't know when it started taking that run because I wasn't watching it. I'm driving still, which isn't safe. I'm not recommending this at all for anybody. But I was the original, driver being distracted by a cell phone, because that was like the equivalent of a smartphone today back then. So I was more interested riding over the Key Bridge, watching those numbers than watching anything else. And look at the response rate off of that level there. See that? Isn't that nice? Just that alone, that one single pass like this, That was enough to draw my interest into seeing what's going on there. Is it repeating? And I'd go through data and I'd see it again and again and again and again. And it caused an obsessive compulsive desire to figure out what was repeating there. And then when I'd go back through price action, I would see all these little details. Okay, and then say, okay, this is what's occurring at this time. This is what's occurring at this time on that day. And then if we had a big news driver, which I didn't understand too much initially when I first started trading, like I didn't care or even worry about an economic calendar. So when I was in there trying to trade, if there was ever a grain report that came out, or if I was trading crude oil and I didn't look at the inventory numbers that come out like around 10:30 New York local time, in the market would create these moves, and I'd be like, whoa, where the hell that come from? Because I didn't have any understanding about an economic calendar. So I started way too soon with money, and I didn't know what I was doing. And back then, I was like a cowboy. I just gunslinging. It's all I wanted to do is be a part of it. Thinking, which is what I have taught against now, because I did that stuff. I tried to learn how to do it with real money, and it caused all kinds of problems, and it slowed my growth. But when we're looking for these wicks, okay, wicks are going to give you so much more detail if you are using them in the proper context. Okay, so I'm watching this as I'm talking. I'm looking at this little gap in here. Does it overtake it, come back down, trade as support, or is it respect it and then roll over and take out the relative equal lows it's formed here and then explore the lows at 8:30? But if I'm looking for turns, okay, when I learned about swing highs and swing lows, we learned them as ring highs and ring lows. Okay, we didn't call them swing highs and swing lows, and the reason why is because you would simply print your charts out, or not print them out, but you would literally draw them out. And so back when I was learning how to trade, we had a service called price charts, and they would mail you one set of price charts for the week, and then you would take the opening price, the high, the low, and the close, and you would draw them physically on the chart because it would give you room. That's the way I learned how to do this stuff. And you have no idea the advantages of what you're learning and how fast you're learning it. Because 99% of you would have never stuck with it if it was like that. And to think of it and being described like that, you're probably thinking, there's no way. But everybody that's 30 years or more in trading, that's the way it was. Like that's the way it was. I mean, people, I watched my generation, we watched things become computerized. I watched electronic trading. I was part of that last generation of old school OGs where price charting was done by hand, every individual candle. And the only thing you did that with was on a daily chart. See that little run right there? Right after that fair value gap, trades up into it, plummets, and the interest is below that low. So if it does this, we're going to see we're going to see a big candle like that expand lower. So isn't it fun watching somebody knows what they're talking about? Isn't it interesting instead of staring at the chart not knowing what it's going to do? But I'm also giving you all kinds of information that are just gold, because this information, if you look for swing highs and swing lows, which is what we called a ring high and a ring low, because for instance, like this little candlestick high, it has a lower high to the left of it here, a high that's lower to the right of it than that one. So in other words, we have a candle that has a high that has a lower high to the left and a lower high to the right. So we call that a swing high. But on my chart, if this was a daily chart, I would put a little circle or a ring right above that. So that way, when I looked at my charts, I could map out market structure. I could see where we are in deference to previous swing highs and swing lows. And if I start seeing swing highs that are forming that are lower than a cluster of swing highs further back, then I know I'm probably part of an intermediate term price run, which is kind of like what I was hinting at here with going all this business here. We talked about it trading down to the midpoint when it was here. We were focusing there, but because we're looking for too much of a precision element, here's where you would have failed using an entry. You would not have been filled, but the market runs with you. Okay, if you couldn't get in there, then you can use this. You see that? Okay, say you couldn't get in here, but then you have the market come back up and trade into this candlestick here. We don't want to see it trade above that candle. There was a gap here, but it trades all the way back up, but it does not take out the high. See that? Trades right back to what? Consequent encroachment, that wick I talked about at 8:30. This could be your entry. This could be your entry. Let me test your memory and see if you kept good notes. What is this candlestick providing you in terms of an entry mechanism? I talked about it yesterday. I talked about it a lot if you've been my student for a while. But this candle right here, what is this candle when it traded there like that? What is that referred to? I'll give you a second while I take a sip of my water. Institutional order flow entry drill. Very, very, very long-winded name, okay? And you're probably saying, why did you name it that? When I teach students how to trade inefficiencies in price action and fair value gaps, when you have a price run, okay, once it enters a significant and obvious sell-side program or sell program, and it's sell-side delivery, that means the market's simply just moving lower, okay? There's characteristics, there's identifications that I use, and sometimes when I'll say those, you'll hear me say, okay, sell-side delivery. You're thinking sell-side liquidity or sell stops. That's not what this is. Sell-side delivery is a sell program where the market is going through the motions of delivering lower prices, and it doesn't matter how many people's buying. It doesn't matter how many people are selling. It's this algorithmically spooling in a direction, and if it's sell-side delivery, it's going lower for the express purposes of delivering lower prices, and it matters not how much buying and selling pressure is there, okay? But when I teach and when I taught students using these inefficiencies, we outlined when we were up here that we first want to see a trade there, and then we talked about all the business in here, and then we talked about going, next target was the lower quadrant, which is there. This is not quarters theories, by the way. Quarters theories is a bunch of bullshit. So I'm going to say it and stop asking in the comment section. I'm sure there's some very nice people out there and they have their faith-based ideas around it, but it's absolute horseshit. So just know that that's my opinion. Please stop asking me about it. The low is the next target. Why? Because there's the liquidity resting below it. So that's sell-side liquidity. The motion from here to here, that run right there, that's sell-side delivery. This high down to this lower quadrant is sell-side delivery. It's delivering lower prices. And then the up close candle, I said we didn't want to see it go above that. In case you're wondering, here's the high. Did we trade above it? No. Okay, so having order block theory, having fair value gap theory, having market structure theory, having institutional order flow theory, real institutional order flow. Do you see any depth of market over here? Do you see any horizontal volume things that make it look like I'm technically advanced? No, you don't need that. All you need to know is where's the mark, okay? Who in the room is the mark? Who's the victim? Because if you can determine who the victim is in the room, you know who's about to fall, who's going to get something they ain't wanting. Okay? If you can't identify the victim in the room and something's about to go down, you're the mark. The same thing happens in the marketplace. If you can't determine the liquidity that's about to be absorbed, engaged, taken out, you're the liquidity. You're going to be used as the cannon fodder for someone else's trade like mine. Okay, so this is sell-side liquidity, yeah, but the way my son needs to start looking at these runs, from seeing this to this target, there has to be something measurable. Well, that clearly is, it's measurable, and you don't have to be in that trade there. There's lots of trades over my career where I could have got in at the highest tick, but it wouldn't afford me the fill. Even offering it by the print, by the time in sales, it traded there, but my volume and contract size wouldn't permit it to be filled there, and it ran without me. And then I had to figure out later on, as a consequence to that, I had to figure out other entry mechanisms because I would be frustrated and angry about missing those moves, thinking that if I couldn't get in that trade here, and I'm aiming for this, this, and something lower. Well, if I couldn't get in there, then I'm done. I'm angry and I'm pissed off, and I couldn't imagine another opportunity to get in because this was all I knew at the time. Which is why I developed the price delivery continuum theory, where it's you seeing something that's underway. I gave you what we were going to see today when we first started the stream. I wish I could have got this stuff to work like it should. It would have been a lot better. But I'm already doing far better than you're going to see anybody else talk about on YouTube. And no knocks against anybody. I'm just being honest. You're not going to see this level of detail. You're not going to get the depth of understanding. You're not going to get it beforehand. You're not going to get all the little tiny subtle nuances because they don't know. And you don't need to know this. You can buy and sell indicators and probably do something mathematically with money management and be profitable. I'm not saying that you can't, but I'm not satisfied with that. Like, I'm a technical freak. Like, I have to know. Like, I have to know why it's going to do it, when it's going to do it, and how I can trust it. So that way I can be leagues ahead, light years ahead of everyone else that looks at these same charts. That's always been my driving force, is to be absolutely phenomenal and freakish. That's been my goal. It's my pursuit. And I try to instill that in my students, but they equate that as they have to know that right away as soon as they start reading it and studying it and listening to me. And they think just because they wrote some scribble in a journal that equates to, well, I'm doing the work. No, you're just now introducing yourself to it. It has to be a lifestyle. Like, you have to constantly be pouring into these charts, listening to my lectures, really dig into what I'm saying, because I'm not talking for the sake of just talking. I'm giving you detail that you aren't going to fully appreciate because where you're at when you first start listening to them, already you're thinking it's too long. I ain't got time for this. Give me somebody else that's going to reduce this. Give me a PDF. Let me find somebody that gives me the cliff notes. You're never going to learn from that. You'll be able to hear the buzzwords and you can talk the terminology in hindsight, but you're never going to do what I'm doing here. That will always evade you because the people you're learning from, they can't do that. They can't do it, okay? And the things I'm teaching today, they've not been taught before. Mentorship students that paid me, they did not learn what I'm teaching you here. This is all brand new stuff. So the price delivery continuum theory is where if we identify a move and anticipate it delivering to a target that it's finite. It's not something that, well, it could do this, it could do that, like a zone. I don't deal with zones. Zones are for fools and idiots. We don't deal with zones. We deal with very specific price levels. If I don't know the price that I'm wanting to see as a entry, a stop, or a partial or terminus target where the trade is completely closed in, if I don't know that specific price, I'm not getting in the trade. Contrast that with supply and demand zones. Okay, what are you doing with that? What criteria are you, and if you teach it, what criteria are you teaching the people that are listening to you? What's the methodology that you're going to come to the same conclusion and process, protocol, guidance that leads you to a specific price in that zone? Which zone is important? Which part of the zone? What prices in those specific supply and demand zones are you interested in? That's why it's a fallacy. It's a fucking joke, okay? It's a wonderful infantile approach to a more visual representation of support and resistance. That was the furthest accolade I gave it. And I mentioned that same stuff when I was on Baby Pits because idiots over there said the same shit. Oh, you're reteaching supply and demand. Motherfucker, everything I'm showing you here has nothing to do with supply and demand. And it has nothing to do with support and resistance. But it tells you to the tick. To the tick. And it doesn't matter what market it is. You're not getting that from support and resistance and supply and demand. You're fucking not doing that. I don't give a shit what Tom, Dick, and Harry said. Dollar mentorships, okay, and the people that run them, they need to backpedal, because if they're using supply and demand and they're trying to sell that shit, many times, if you really, really listen to them, they're really trying to teach order block theory. They're trying to teach what I do, and they're falling short of it. Okay, and I know this is the part of the videos you don't like, but I have to answer all these things because people send me shit and they question me, and I fill in a lot of questions within my dialogue. And also scratches an itch once I get it once in a while. I have to scratch it like anybody else will. But if you have wicks in your charts, okay, every single time you have a wick, every single time, you want to be measuring them from the highest high and the lowest low, okay? Because in swing highs and in swing lows, it's going to give you detail that nobody else has. But me. But me, good old ICT. But you're going to get to that. You're going to get it. You're getting it right from the source. If there's going to be a high, and this is on any time frame, folks, okay, write that down in your journal, in your study notes. This is a principle that is all time frames, every single time frame. And this is what you'll find is fascinating. If you go through all time frames and you study this, and to see them form on sub 1 minute charts, and it's still there, that is incredible. It is incredible to see. It's incredible to see your baby do exactly what it's supposed to do. And it's so pretty. It's so beautiful to see it form. And sometimes when the people that use it push hard and intervene with it, take it out of its processes and what it's following at the time, its script, and they cause a manual intervention, then it gets a little blurry. But if you just simply wait, it'll go right back to doing what it's supposed to be doing. Rigged, controlled price delivery. That's exactly what we have. And there's no reason to be upset about it. There's no reason to fear it. You should be thankful it's this way. Because I'll be honest with you, with 30 years experience, if these markets weren't rigged, if they were not rigged, I would never trade them, because you have the equivalent of doing the same thing that people do when they buy lottery tickets. Going to the casinos. That to me is madness. But if I can go in and I can see, okay, I can systematically prove that these things are happening. They're predictable. To a degree of precision, it presses the viewer or anyone that studies and looks at it, especially when we're doing it live, it forces them into a corner, and they're like, either this guy has a time machine or he's using delayed data and I'm using the lowest latency on this live stream. And I have students that verify it. I'm seconds away from when you see it and when it happens. And if you have real-time data, you already see what I'm annotating on the chart. I tell you where it's going to go beforehand. So it doesn't matter. It can be delayed 10, 15 minutes. It's still in the chart before it's there. And then when it finally delivers, there you go. There's no escaping it. So it's predictable. It's logic that's transferable. You can learn it. But if you're looking for turning points in price, that means short-term highs, intermediate-term highs, long-term highs. Short-term lows, intermediate-term lows, long-term lows. Where they nest out in the grand scheme of things, when you have a directional draw on liquidity that's discernible, that means that you can reasonably forecast where the market's trying to go to. That's the first lesson for you, Caleb. All of this stuff is just, once you get beyond that, when you're studying for the day and you watch and observe where price is going, and you're watching the live streams like this and you see that telling you where it's going to go, and it goes there, then you go in and you fill in your observations in the chart. You annotate how much time it took for this run from here down to that level we were aiming for. And you make notations how the body's turned right at that level. Trade it back up into the fair value gap, consequent encroachment of this wick, because it's a wick that's above price when it was down here. So if it returns back to that, that's a premium array. But I don't care about the low. You see that? I don't care about that low. I want to see it trade through that. I want to see it dig into this and go right back to that. Because if it can do that, then I'm waiting to see, does it stop? Or if it wicks through it, does the body that it pierces it with, does its body stop at or below that consequent encroachment? Because that's the signature. That's a little telltale sign. That's me at the table. I'm the dealer. Okay, I can run up a deck and stack the deck, and I can send somebody a hand of winning cards, and everybody at the table won't even know it, and they can be a confederate with me. And we run the table. Ever seen the movie Rounders? Matt Damon and what's the gentleman? He lives in Maryland. He played the Incredible Hulk. Edward Norton. He plays the guy that does all the chops. He was in prison, came out, and while he was in prison, he was learning how to do all this stuff with cards. And Matt Damon was just a good poker player, but Ed Norton was a cheat. So when Ed Norton was dealing, he was dealing good hands, stacking the deck up for his buddy Matt. And Matt realized what was going on, and he was like, listen, I want to play for real. I don't want to get caught doing this. And he ended up getting caught. And that's another discussion. This is another discussion for another day. Just know that I really enjoy these lives, but they're almost problematic for me because I have so many things I would love to talk. I really should have a podcast. I mean, I really should have one because I could never run out of things to talk about ever. Literally never, ever, ever. But when we're looking at the wicks, okay, I want to see it go up and fail. Okay, or stop. Give me that little signature. It's like me tipping my hand to another player at the table and showing them my cards. Okay, well, that's what the algorithm's doing for me and for anybody that trades like this. And before I stepped out and started talking like this and revealing this language to start seeing it this way and looking for it, nobody believed that there was an algorithm that controlled price like this. And there's always been a group of people that you're not hearing about. They don't write books. They don't go on CNBC. And they do the very things I'm telling you how to trade and engage price. They do that. And they do it on a very large scale. All day long. All time frames. Okay. And they also have algorithms that are keying up off of these very things. So they're not sitting there looking for these things. Okay. Quote unquote smart money traders, algorithmic traders. They understand the things I'm showing you visually, but these are the closest things that I can teach you to see the phenomenon that's going on at that moment. There's other things that I'm not in the position, let's put it that way. I'm not going to teach it. And I don't give a shit who comes to my house and says, I'm not gonna do shit. Okay? I'm not telling you shit. You want my technology? Fuck you. You can't have it. But you can have these things. You can have that. Tell me I can't? Well, I'll make more of me. Okay? So if you have these little hints, these little billboard signs flash and say, I am not going any higher, and here's proof to that you can trust. See, that's a real indicator. If you start applying things that are mathematically calculating old data for the purpose of overbought, oversold, divergence, trend following moving averages, ratios, Fibonacci ratios, if you're doing any of that stuff, listen to me, and I mean this sincerely. I know there's a lot of people that don't like me, that stand on that dumb shit. They sell courses, they sell software, they do all kinds of stuff, okay? Whether you believe them, whether you believe me or not, I'm just going to say this is the truth. Price literally doesn't give a fuck about any of that. It doesn't. It does not mean that that's what causes price to go up and down. Absolutely not. It doesn't do that. But what price does refer to is time. If it's the right time for price to move, it will move. If it's not right time, it ain't going to move. It'll just gyrate and fluctuate in a predetermined range that is mathematically calculated by the algorithm. I'm only going to go this high. I'm only going to go this low for this amount of time. And then I'll go just a little bit of that highest high in the last range. And I'll go down below the lowest low in the last range. And I'll go right back in the middle of that range until it's time to start spooling. At session starts and session endings during the macro periods at 20-minute intervals at the top of every hour. All these things start to come together like a puzzle, okay? And when I was on Baby Pips, I was testing, laying out breadcrumbs and see, out of all the people that come here, I want to see who can pick it up, and not one person could. And then I did a mentorship. I'm going to see, can they jump and do these quantum leaps? Like I was getting these huge like downloads of understanding and seeing, wow, this, yeah, you can really see some of these things in not a lot of it, but you can see enough in price action where the concepts, the theology behind when price and why price should do anything, there's certain times when price doesn't hide it. And that was the fascinating thing for me, because I've known it for a long time, but it was me trying to find a way where I could talk about it. And I'm talking about these little things like this. That's not really what's going on in price, but visually it's occurring at the same time the algorithm's doing what it's doing that I can't talk about. And then that's the part that some of you get pissed off about. You're like, oh, well, you're hiding stuff. You're fucking right, I'm hiding something. You're right, I am. Absolutely, I am. You would too. You would too. You wouldn't even be teaching this part of it. You keep it to yourself. But I have an obligation. I have something I have to fulfill. And I have a bone to pick, really. So this is my way of doing it. And I have been successful in transferring this information with this language. It's resonated with a large number of people all around the world. And my daughter actually sent me something. I just want to toss it in because I was kind of interested by it. Last night, or yesterday evening rather, right after the markets closed, I got a text message from my daughter, and she goes, do you see this person? Do you know this person? And she sent me like a profile of someone on Instagram. I'm not on Instagram, so she has to send me screenshots to see it because I don't know I can't access anybody's account. I'm not on Instagram. I'm not on Facebook. I'm not on Discord. I don't have anything to do with that stuff. So if anybody's using my name, it's not me. But she asked me, do you know this person? Because they had my logo in their profile, which a lot of people have that. It's like a brotherhood symbol. And I have students all around the world. They're getting it tattooed on them. Please don't do that. I don't know what you're thinking, but I get it. I understand what you're doing, but the Bible says, "Take no mark upon your skin," and that's exactly what that means. Don't do that very thing. I don't have a mark. I'm not forcing people to take a mark, and my logo certainly isn't the mark of the beast either. But there's individuals out there that take my logo and they put it in their profile and then use it as their avatar. And the person she was asking me about, I said, well, I know of this person. They're a student of mine, but what spurred that on? She goes, well, I'm looking at the new Bachelor. Apparently there's a show called Bachelor something Bachelor. Okay. And because she's a single woman, she likes those kind of shows. And apparently the new Bachelor is a day trader. And Ellis, I don't know if that's the last name or if it's the first name, Ellis something. Well, anyway, she looked at his followers and who he was following, and he's actually following something or someone that's one of my students, and it's something lab, scalp lab, or scalping lab, or something to that effect. And they have my logo as their avatar, and they're on Instagram. And this new Bachelor on this TV show that does something around being a bachelor. They're a day trader, and he's following this particular person. And the question was brought up by my daughter. She goes, "Do you know this person?" And I was like, "I don't know them, and I don't, off the top of my head, I don't know who the person that's going to be the bachelor is." But he's a young guy, and it was a picture of it, so I couldn't really make out who it was because I could only see so much by zooming in. But if you know more about it, like especially if you're like in my private mentorship, if you know if you know anything about it, just send me a message about it because I'm intrigued by it because I've heard my name talked out of Andrew Tate's brother's mouth. Like I'm all over the place. I'm Mr. Worldwide, but I said that to my daughter last night. She was laughing, but it's funny. It's really funny to see how far this has reached out to like all these individuals around the world are familiar with me, and either with me or they are familiar with what I've introduced to the community because other people are using it and implementing it, and they have a following of their own, which is fine. I got no problem with that. I just don't like it when people try to pretend they know how to do certain things that I've never fully taught, and they try to sell mentorships, egging people on. That's that's fraud, okay? Because you don't know what I know. But if you've gone through mentorship, you know what I've taught in mentorship. But now that's for free on YouTube now too. So, but I digress. the I got to tell you, I love live streaming because it gives me an outlet. Okay, it really gives me an outlet, so I can say what's on my mind and when I want to say it. But unfortunately, it's hard to follow me if you're here just for studious purposes. So I understand, and I can appreciate your frustration if you're someone like that, but just know that I can't not be me. Okay. And people have asked me to change for years, and I'm not going to do it. I can do as much as I can to try to do what I want to do and still meet the expectations or whatever I have in mind to do. But I also have to be me, and no one's going to change that. And the way I deliver the information is the way I want to deliver it. And I have to be happy with the way I do it, or I won't do it at all. So it takes a great deal of filtering if you're here just for the nuggets, okay? And when it's live streamed like this, like it was on Twitter Spaces, it's the good stuff being tucked in. And sometimes that's intentional. Like today, it isn't intentional. It's just me being organic because I'm finally relaxing about the frustration I had with trying to get OBS to start streaming. It pissed me off. Like I was ready to throw this fucking laptop through the wall. Like I was getting angry. I was getting so mad, but it is what it is. But I want you to think about wicks, okay, and how every swing high and every swing low that has a wick, the information is useful if you start measuring them, finding out where the midpoint is of the wick, the highest high and the lowest low. And if we start doing that, we can start forecasting things in price action that would otherwise be it's unknown to other traders. Okay, and I'm going to introduce some of the principles today. It's meant for you to go into your charts and explore it, study it. It's a fascinating subject matter. I spent years looking at these things, and finally, after 6 years, because I figured it out in like less than 3 years, like two years and like nine months or something like that. I had everything exactly what I wanted, but because I have to take things apart and tinker with them, I was that kind of boy growing up. I had a Stretch Armstrong toy. I had to find out why it kept going back to its normal size. I had to figure out what was inside of it. So I cut it open, and it's like this little gel stuff in it. And I needed to know why my remote control cars worked and what was inside of the thing behind where the battery panel was. I had to take things apart to see what they did. And it mattered not to me if I could put them back together. I needed to know what made them work. And from someone's perspective that doesn't appreciate that inquisitive nature in a human mind, they may see it, well, this kid's a brat, he's a destructive person. Look at him, he's breaking things up. But that was the fuel for me to be who I am today. Because everything that I get involved with, I have to understand why it does what it does and how it does it. And if I can't ascertain what that is, if I can't get a grasp on it, I'm not interested. It can't hold my attention. So I have a demand on anything that holds my attention that it has to do something for me to hold my attention, or I'm not interested. And in trading and using these concepts and not exploring price action, I have found that, and I've had lots of students come through me, and the characteristics of impatience, and I need you to start saying less and just teach it, and stop talking so much, you're never going to learn from me. And you're probably not going to do well with anybody else, because what you're trying to do is condense. You wanted to have uh, um, a distilled version of all this information. And when you really take a step back, there's no advantage of distilling any of it, because you have to have a complete perspective, because they all link together as one symbiotic unit. It's not one thing and stands by itself. A wick, and the details I'm going to teach you about this that leads to understanding turtle soup. You thought I forgot about that? It's just the preamble here. The idea of anticipating turning points in the marketplace, which is what a turtle soup is. It's a run on liquidity, but it's not always running above an old high. It's not always running below an old low. So when I say turtle soup, it was me nodding, because I like the name, it was cute, of what I saw and read about in the Street Smarts books by Larry Connor and Linda Rasch. And I said this before, and I'll say it again because I mentioned the book again. I get nothing from it. I'm sure she probably knows about me only because I've commented to her, I think twice when I was on Twitter, and she was tagged in a response. And I'm sure she looked at me and I was who I am. And I'm sure I'm not her cup of tea, and that's fine. But I think her book with Larry was a good book. It's expensive, yes. Would I still pay that price if I hadn't bought it at that same time in 1995? Yes. I paid $175 for it. I don't know what it's selling for today. Unfortunately, it's been copied and put all over the internet. You can get it for PDF and for free. I don't want you to do that. You know, if the authors are going to take the time to put the information together like that, regardless of what they sell it for, you shouldn't take the information and circumvent the payment for their information, their experience that they collected to put it out into other people's hands. There's a lot of things in that book that I don't like, but it did help me understand stop runs. It helped me formulate a visual representation, because that was the first introduction to it. Because remember, my original mentor was Larry Williams, and Larry Williams doesn't do any of this shit. He doesn't use nothing. He doesn't use any of this stuff that I'm talking about here. Everything in my mentorship, all that stuff, technical fair value gaps, institutional order flow, inversion fair value gaps, breakers, that's not him. Okay? I had some dickhead write a book on Amazon and try to say that my stuff was Chris Lorre's stuff, Larry Williams stuff, Sam Seiden stuff, supply and demand, and all of that is the biggest fucking lie. It's a joke. And that's why I invited everybody I purchased his horseshit book just so I could leave a verified purchase review saying this is all nonsense. You can go to my YouTube channel and you can see everything that this fucking clown wrote about is my information. And none of these other people had anything to do with it. And you asked them directly. And that's why I went out and caused Chris Lorre to answer me publicly on Twitter. I said, listen, I'm tired of these people saying that I've copied you. We're going to court if you don't do this publicly, because I didn't take shit from you. Do you see your material in my concepts, in my lectures, in my teachings? Yes or no? And he handed it all. I said, listen, you got 30 fucking minutes. And I got the emails to prove all of it. You got 30 minutes to come out on Twitter and respond publicly. And he comes out and says, no. And he goes all this other extra bullshit trying to save face. But there's your answer, everybody. I don't teach Chris Lorre's bullshit. Okay? I don't teach Chris Lorre stuff. I made the mistake of giving him a nod and sending him people. And I found out through other people sending me emails saying he was talking shit about me. Listen, you bite the hand that fucking feeds you, that helps set you up, you can go fuck yourself, pal. I don't need anybody else to help me. I don't need that. I got one person in my corner, and he ain't on earth. So it's just a one-man army here. I don't need allies. I don't need people supporting me. I don't need worshipers. I don't need cult members. I don't need students. I don't need it. I don't need to do any of this stuff. I enjoy this stuff. I enjoy sharing it. And it just pisses me off when I see other people lie and they discredit me and say, oh, well, you didn't do this and you said this because somebody else's stuff is over here. It's horseshit. You got $5 million. I'm going to remind you all, $5 million. You come forward and you show where any of the stuff I'm teaching is found anywhere prior to me. And a lot of this shit was codified in 1996. Prior to that, it was conceptually being discovered. I was figuring out certain things, but I put it in a format where it is linked to me, 1996. And then all of a sudden you hear about stories about there's a market maker that was flying on an airplane and I met this guy. And then all of a sudden that's urban legend. But you're hearing it right from that person that guy's talking about. Hello. Think about it, folks. I've been around the block for a long, long time, multiple times. I've had more personalities online than you realize. Inner Circle Trader is just the longest one. Mm-hmm. A lot of big names have their hand in my cookie jar. Let's put it that way. My hand's not in theirs. So let's talk about the wicks, okay? I had fun, so let's get into the nitty-gritty with it. If we refer back to this one here, as I mentioned, if price is ever reaching up, okay, if price is ever below it and you have a reason to suspect that it may go up for the sake of retracement, for the sake of a long trade, and it is likely to continuously move higher, you have to contend with the information that's being presented inside of the wick, okay? Inside of that wick. What specific information? If you're below it, it's going to come up into that midpoint. The midpoint is consequent encroachment. Why does it not mean threshold? Because it is a gap. Gaps, midpoints are always consequential to its return back into that range of that gap. So consequent encroachment. It's encroaching on the mid part of that gap or inefficiency. So because when I look at a wick, I treat it as a gap. Even though it moves in one single candle, passing from the open of that candle down to the low, I don't care how long it takes doing it. That's not an important factor. The visual representation of that is enough for me. Then I go right in and I measure it. If it's a long range wick, something like this one over here, I'm going to get a very specific calculation and I want to know the very number. But if it's short like this, I can eyeball that and say, okay, well, we're in close proximity to the 6 p.m. opening price. We're also approaching the consequent encroachment of this gap, which is this candle's low and this candle's high. So half of that. Okay, so here's a convergence of three things there that build on, this is a good idea to anticipate lower prices. But you already knew lower prices were in order back here when I finally got the stream going. You knew yesterday that this is where the NASDAQ could potentially reach up into if it was going to continuously move higher. Look at the turn there. What is this candle doing right there? This one. What's this candle right here? What is it doing? It's trading below that short-term low. Yes, absolutely it is. But what else is it doing? It's validating this candle as an order block. What kind of order block? It's a bearish order block. So once we get below and close here, we have a shift in market structure. But before we do that, that order block is validated. That's the change in the state of delivery. What does that mean? What does that mean when I say it's a change in the state of delivery? This candle opened and there was buy side delivery. That means the market's moving higher. It keeps booking and offering higher prices. That is buy side delivery. It's going up to go into that inefficiency I told you yesterday. That would be an upside objective if it continued moving higher. It's also taking out this high here, this high here, this high here, and the high formed at the 8:30 news driver and release that it created there. So it went up there and kept that gap in play. That old new week opening gap on July 28th of 2024. Some old reference point that everybody knows about these gaps, ICT, but nobody was doing this with them. Nobody was extending them in the future. It was filled. All right, that's done. Cast it out now. It's no longer valid. It's one and done, over. No, it's not. I've had so much fun over the years watching people literally talk about price action, and it's staring right at them every single day, every single week, for weeks at a time, and it's completely, they're oblivious to it. And they're taking trades that would otherwise be contrary to what that implies. Hey, I'm going to go long. We broke out above here. So it's probably going to keep going because they're a momentum trader. And they don't know this information. They don't have this information that you were given yesterday. Do you see a repeating phenomenon? Like, I'm always able to tell you with these concepts what is the most salient, and then the market behaves around them as a manner of proving the concept, the logic, and the predetermined aspects. It's before it happens, not after the fact. It's before it happens. Because if these things don't have a logic that I'm able to tap into, and it never is deviating or changing or morphing into something else, that means I'm confident. That means I'm, to a lot of people's perspective, I'm arrogant and conceited and narcissistic, okay? Because I'm absolutely confident that this is going to continuously keep working. That's why when I talk, I don't sound like I'm second guessing myself. I speak with authority. That's why that tone is always there, because it's mine. It's mine. Okay? And I'm sharing something that you wouldn't otherwise know about. But if we look at these elements and you introduce the idea of swing points, if you're trying to capture a reversal pattern, okay, there's two forms of reversal I want you to think about, okay? There are reversals for the sake of changing a buy or sell program into an opposing buy or sell. Meaning this, we have the market's been going higher prior to 8:30. We've had this, all this consolidation overnight, all this meandering around. We had the stop hunt, rally up, and then go to where we were talking about yesterday. All of this is higher than where we were trading yesterday at the beginning of the stream, 9:15 or so yesterday, Eastern time. So it's been going higher. And it went to some random level that was given to you in advance yesterday. And then it behaves like this, breaks down. So we've been a part of a buy program. It's been going higher. We had to wait for the news driver this morning, and then it continued going into the upper, higher premium levels that we talked about yesterday. Towards the end of the stream, I gave you, okay, what do we do with it now, where it's at? And I walked you through certain aspects of where the price could go if it's going to remain going bullish. Here we have it. It trades up to it here, and then it folds and drops. Now, if I didn't teach the new week opening gap, if you didn't know anything about this concept, okay, this run above this high, for a majority of you, you wouldn't expect that type of reaction, going there and then breaking down. You wouldn't expect it. If I wouldn't have taught fair value gaps, you would have never even looked at this area here as a point of interest for you to study it, using it as a point of entry going short. If I wouldn't have taught breakers, which is what this is, high, low, higher high, that takes out liquidity. But notice it's taking out liquidity, and then it's going somewhere specific. It's not just going above. It's not, oh, this is an engulfing candle. It's a FU candle. That's an institutional candle. It is not an institutional candle. This is an order block. These two candles here, but it's that opening price. That is the change in the state of delivery. So when I say it's a change in the state of delivery, Caleb, I'm telling you that what was in play prior to those candles formation? Where was the market going? Up. So that means the market was in buy-side delivery. Suspend your disbelief for a moment, okay? Just give me the moment to speak in these terms. If you're one of those individuals that are in the audience listening and you think there's no algorithm. Bro, I work at so-and-so investment bank. There's no fucking algorithm. Okay, come out here and do this, what I'm doing, and I'll walk circles around your ass. You can use all the bullshit that Goldman Sachs and all the fucking Citi, all the shit that you use. You come out here live stream, and I'll tell you every fucking 1 minute candle, and I will call it all day long, and I'll run circles around your ass. The invitation is open. It's open. If you want to come out here and get on Blast Street, come out here and get on Blast Street, because I will make your shit look like Mickey Mouse romper room nonsense. Okay? The change in the state of delivery in this instance is we moved from buy-side delivery. That means it's being offered higher prices, not because of buying pressure, not because of an absence of selling pressure. Okay? It's algorithmically delivering to a fucking level I gave you yesterday. How's that possible? How is that possible if the markets are random? If it's not rigged, I couldn't do this stuff. I couldn't sit here on a live stream with the lowest latency and point out certain things in price action, and they deliver over and over and over again. If they weren't rigged, I couldn't do that. But because they are rigged, you should find solace in that. You should fucking walk around with a heart on. You should be thankful that it's like this, because it's something that's going to repeat. And it's going to give you a happy ending every fucking time you use it, because it's there for you to take it. It's there for you to take it. But prior to me revealing it, it's an unknown. It's something I had fun with. They're my toys. So the change in the state of delivery at the opening price of an order block flips it from, in this case, from buy-side delivery, offering higher prices. Again, don't think buying selling pressure. Just think it's going to offer until it gets to that price level right there that you knew about yesterday. Then, does it reject it? Yes, it does. Does it overshoot the opening price? Right there it does. And I don't need to see it close below it. F you, candle. These fucking 20-year-olds. But there's 20-year-olds that'll eat that shit up though, won't they? Chairman. Chairman. They call themselves fucking chairman. Sit in their fucking chair, boy. You know what you're talking about. The opening price is the change in the state of delivery. In this case, as soon as we get that crossover there, the algorithm changes its state of delivery from buy-side delivery to sell-side delivery. Oh. So that means it's going to refer to this price. It can color a little bit above it. Up to how much, Michael? How much of a gray area is this if it wants to trade back into that mean threshold? How do you properly outline that? You take the opening price. Opening price. Man, I should be charging money for this shit. If you like what you're learning today, if you're really having a good time hanging out with me and learning shit that nobody else on this planet's going to ever teach you, the stuff that really works, that causes these markets to turn on a dime, on a time schedule that you can predict and expect and forecast weeks and months and years in advance, if you're having fun, I'd appreciate a thumbs up. You guys got real lazy the last few times. You haven't been giving me thumbs up. I told you, that's our currency here. That means that I'm hitting the sweet spots. I'm touching your G-spot. I'm tickling your ass with a feather. I'm giving you things that you've been wanting all this time. I'm delivering it. And I'm doing it over a live stream. What else could you want? What else do you want? You want to see me trade? You'll get it. It's coming. But I got to give you the logic that we're using. So that way you can see every time I'm doing, oh, it's the same shit he talked about. Yeah, it's the same stuff all the time. But this rally up in here, okay? The body. The wicks are what? That's where the little, like the fuzzy areas, the parts that, like your child that colors for you. They're coloring the picture, and you see them color outside the lines a little bit. Again, I mentioned the analogy last week. You're not going to scold your child because they colored outside the lines. You're going to be like, they signed their little name, probably misspelled something. You're going to go to your office at work, or you're going to put it on your refrigerator at home, and you're going to celebrate it. It's to you meaningful. Well, you're not making a big deal about your child coloring outside the lines. So I'm not making a big deal about my algorithm coloring outside the lines by these little tiny little nodes of errant price action, where it just goes just a little bit outside of it, because they're all coded too. That's where the damage is done. So I want you to focus on what the bodies are telling you. Inside those bodies, you want to measure that. Because the mean threshold of the bodies in not just single candle, but because they're consecutively up close candles, that makes the bearish order block. It's not just the last up close candle before the down move. That was the trap. I knew people would go out there and start using it and start pretending like they didn't learn it from me. Oh, it's Wyckoff. Oh, it's supply and demand. Bullshit. You have to take all of the candles because this is the state of delivery that was in play, buy side. Soon as we cross this opening price right there, that means the algorithm has changed, switched script. Now it's offering sell side. That means it's going to explore lower prices. Is it just going to randomly pull shit out of its ass and say, well, let's just go down here, let's go over here? Or think about it like this. And I'm obviously being facetious and I'm being a dick right now because I want you to understand the fallacy in believing that there is no algorithm, that these things are just completely random buying and selling pressure. Pray tell, how the fuck are we going from the opening price here and we're trading up into that little range here, but we're staying below the midpoint, which is mean threshold. We are not piercing and going above that fair value gap. We stopped one tick below it. So it's like something other than everybody else's retail stuff. How is it that the market's going to reach back through all of this price range from that high down to that low? Where is it going to gravitate to? And why is it the same logic that I'm teaching and taught millions of people around the world? They're able to use this information and they're able to get funded account payout. They're able to trade with real brokerage firms, not some horse shit, real brokerage firms, and getting withdrawals and paid out. They're paying taxes on their trading wins. It's not market replay stuff, okay? How is it that the things I'm talking about and how the market will reach back to them, why does that occur more than anything else out there? And how is it that if there's so many things in this industry that you can use to trade off of, and yes, you can do that. You can trade on, anything. Weather, like I made fun of yesterday, the lunar cycles and whatnot, the planetary alignments, all that stuff is nonsense. That doesn't make the market go up or down. It doesn't do that. So if there are all these different principles and disciplines of trading, how is it that the market agrees to use the theology around Elliott wave one particular day, or harmonic patterns this day, or Dow theory this day, or supply and demand this day, or Wyckoff this day? Because they all do not agree, folks. Study them. I have. I listened to all that horse shit in my first 3 years. And every bit of it is dog shit. It's dog shit. It's all dog squeeze. It absolutely has no bearing on what price is going to do. But it feels good having your faith placed in something, so therefore it gives that team mentality. And that's why everybody that's outside of my community, when I teach this stuff, regardless of how precise it is, regardless of how many people are making money with it, regardless of how many people have proven it works, not in my own hands, that's not enough. Everybody else that has done it and used it and make money with it. You have a huge, daunting task of proving it doesn't work when you have such an army of witnesses proving that it does work. But everybody outside our community takes shots at me because I'm an equal opportunity prick. I'm going to piss in the cornflakes of everybody else's stuff because it all doesn't work. Because they think it works. That's not enough. You can't sit out here and every single candle use your theology and explain why it's going to do it. And you can't call your shit beforehand and map it out all day long on a 1 minute chart. You can't do it. You'll have a hit and miss type thing. Once in a while it'll happen, but you'll champion that like a pony. Here's my pony show. Look at this. Here's my one trick pony win today. But it's altogether something when you're out here over live price action, not market replay, not hindsight shit. You have to be able to draw the analogies from something you have seen work for decades, that you had a hand in, that you authored. You getting what I'm putting down? You getting it? Are you getting it? There's nothing like this because everything else is external to the market. I am the market. This is the actual source code. This is the stuff that goes on every day. And when they put their hands in there, and you start monkeying around with it, you have to take a step back, wait for it to go back into doing its normal following its scripts. But we can identify when a script is changed. Remember that little scene in the movie The Matrix? They're inside the building, and they're inside the Matrix, if you will. And Neo sees that little black cat. He walks out in the opening of the doorway, and all of a sudden he sees it again, and he says, "Oh, that's weird. I'm having like a deja vu moment." And because they all realize that he noticed something. And true, yes, it's a movie, but the analogy is the same. They said, "What did you see?" And he goes, "Well, I saw a cat, and then I saw it again." He goes, "Oh, they just made a change. They just made a change." That's what this is doing. Okay? Watch what's happening. The market trades up to a level you were told to anticipate yesterday as an upside objective. The fact that it draws to it is one part, but does it draw to it after creating relative equal highs? Failing to hit it on the 8:30 news driver, because I would have preferred, and while, truth be told, while watching it, I anticipated that to hit that. And I was surprised that it didn't. But all it did was stay inside the range right here. So they left that high intact there, traded just a little bit above that one there, and right in here. So what are they doing? What are they doing as a helping hand to the retail trader? Well, they're giving them what they're looking for, right? They're giving them resistance. So what are they going to do? They're going to try to sell short right at this level, or maybe just a little bit above once it starts moving in their favor, because now they're convinced it's going to go lower. So where are they going to put their stop loss? Oh, that's easy. Right above where the book's telling, right above these highs. And if it's not a good enough point to do that, the ones that are real prudent, they don't want to get stopped out, because hey, they know enough about support and resistance that sometimes it goes just a little bit above it. So they're going to be really smart and put their stop loss right above that high there. Okay. Well, the algorithm knows that, because those highs and lows are formed by it, not the buying and selling pressure. But it also knows the fucking shit that I gave you yesterday, which is the logic. It's going to go up to some random bullshit level found in another retail idea. Nope. New week opening gap right there. Bang. Then it overlaps it, changes the state of delivery from buy side to sell side. That means every premium array, everything that could be used as an ICT trader, smart money concepts that are used for shorts, anything that would prevent price from going any higher, that's what your eyeball starts looking for. Okay? But you go through the range. This is where we made the high. This is where we changed the state of delivery. And now we're in a move that is in sell side delivery. That means you're in a sell program, folks. That means the market's going lower for the express purposes of repricing to any inefficiency. That means a fair value gap, buy side imbalance, sell side inefficiency, sell side imbalance, sell side inefficiency, or wick, consequent encroachment. Ooh, that is so good, ICT. That's starting to make sense to me. Good. From that high to that low, we can go back through and see everything over here and down into that wick. Where's the pertinent, useful information? Now think about this. Think. Because Wyckoff doesn't do this. Supply and demand doesn't do this. Elliott Wave has no fucking idea. He's still waiting for a wave. He's sitting out there on a surfboard waiting. The big Kahuna ICT is out here calling it live, riding the big wave. Calling every little tiny little tube. Going through it. You can see me out there. See it? See the sun glistening off the crest of the wave? You see that? Look at that. I'm not even getting a sun fucking burn. It's beautiful. No sunblock necessary. I'm bringing the fucking heat. This guy's a character. So the high to that low, you go back through all of the price movement here. Okay, and what you're looking for is anything that was offered as a discount array when it was going up to that high, it will reverse its role. That's how I know which PD array to use as an inversion level. Okay, if we are looking for in here, let's say it like this. See how we have a gap here, and we have a gap here, and we also have this down close candle. So we have a gap inside of the range of an order block. You have to look at that and think, okay, that's something that we can use as a buy, and we see it there, and it was valid there until we get to this high and over here. So this has been used there as a buy. So extending it further over here, what can we anticipate it acting as? Some form of resistance, an inversion. Okay, so as order blocks, they can invert, they can reverse their role, their characteristics can change. Just like these candles here are showing you that little glitch in the matrix, that deja vu moment where Neo said, "I saw a cat." I feel like I saw that same cat do the same thing. And the other members, like Trinity and Morpheus and whoever else, the people, I don't remember their names, they were like, "Oh no, there's a change. We got to go," because they know that the agents were in there making changes, and they found them basically. Okay, well, what you're doing is you're looking for these little changes in the algorithm. When price changes, it's routine. They're never, ever, ever going to be able to change this, folks. I don't know how to say it any plainer than that. Okay, what they can do. Let me make some devil's advocates. These little. Okay, this is what could happen, but it still doesn't change it. It just means that you might take a trade with this information, and then they run that high one more time. Boom. Okay, well, you just got stopped out. That's all. It's happened to me before. It's happened. You watched me do it the other day. I was showing you my trade, and I even told my son, I said, "I'm going to show my trade, and as soon as I make my stop loss public, good old Phil, right to the stop, and then it'll go where I want it to go." But it doesn't change the fact that it was a winning trade. Okay. But the point is, if you get stopped out, you just got stopped out on that transaction. It's just one trade that's the outcome of that one. But you can't take your attention and say, "Well, this means everything's flawed and it's never going to work. So let me go find an indicator." No, it just means that individual transaction, like that one day driving to work and you got a flat tire, you didn't know you were going to get a flat tire. Is it possible you're going to get a flat tire? Sure. Are you going to stop going to your job pissed off in defiance because you got a flat tire? There must be something about that place where I work at. Fuck that guy. Fuck that person that runs that company. Fuck that company. Fuck all the time and tenure I put into it. I got a flat tire. Fuck them. I'm never coming back. That's what you're doing when you say, I'm going to work with a methodology, but it's the first time it fails on me. I'm done. I'm looking for the offering. I'm going to change. I'm going to start looking. That's a system hopping. And traders that start out in the beginning, they do a lot of that. I did it. I ain't got no shame in telling you because I didn't know any better. But when you come here, when you're listening to me, I might not be so eloquent all the time when I speak. I may not be your cup of tea for someone to listen to around your children. Okay? But I'm not going to give you bullshit. I'm going to give you the stuff that works. I'm going to cut to the bone marrow. I'm going to get right down to what matters most. And you think I'm not getting to what matters. You're not getting to the point, ICT. The point is you're going to fuck up if you don't listen to everything I'm telling you. That's the point, but you don't want to hear it. It's good medicine. It might not taste all that good, but swallow. Okay? Swallow. It's good for you. So now, when this cross over that opening price, we're interested in seeing everything gravitate lower. So because I'm teaching my son incrementally to build in these objectives of just looking for small little modular moves. Small little modular moves. Let me get this off now because we've had it there long enough. The asshole over on Instagram pretend to be me with 200,000 followers, whether they're real or not, I don't know. I love pissing in his face all the time. So that level right there, it goes up and just touches. Well, it doesn't really touch really because that's the high. We were one tick away, a half a tick away, and a quarter tick away in here, but didn't get into the fair value gap. It did use the breaker here, and it did qualify and prove that change in the state of delivery, we want to see it roll over. It does. This wick, we talked about how when it went through that, the market's going to come right back up because it's going to use this reference point and this fair value gap and this old key price level at 6 p.m., the opening, because there's no difference between where we closed yesterday at 5 p.m. That closing price and the first print at 6 p.m., they're the same price. So you're just going to draw a line like that. You can annotate that anything you want. You can call it the 6 p.m. opening price, no gap. Or you can just say new session starts 6 p.m. I don't ever have a name. It's just I draw a line. Okay, so if I wanted to have a name for it, it'd be one of those. You can name it whatever you want. I'm sure it'll be in somebody's Amazon book, and they'll talk about it. They won't credit me though, and then if I find out about it later on, because somebody's going to eventually buy the book, and they're going to say, it sounds like ICT's bullshit, and then I'm going to hear about it in an email, and then I'm going to buy their bullshit, and then I'm going to go on their reviews and say, this is horseshit, it's all lies, go to my YouTube channel in this fucking video, and you'll see that this is where they got it. And then nobody wants to buy your book, and they call you an asshole and a plagiarist, just like John Fibolotti did. So if we see that the market, it does in fact go down to our intermediate term price level, which is what? The first target below all the bodies. See all these candlesticks right here? So ignore this wick for a moment. Okay, see all that? All this range? Ignore that for a moment, okay? And say price only looked like it did with the bodies and not the wicks underneath them. So the market dropped down here, all these bodies, and then we started going up. I want to target something below those bodies. So what PD array do I have below them? Well, if I use this closing price here, that's a rejection block. You can use that. And I taught my students this. That's a level to aim for as a partial and see if we can get to it. And then hold on to it and see if it can go down and continuously move. But I didn't introduce every aspect about wicks. They're learning it right alongside of you right now today on August 14th, 2024 on live stream on my YouTube channel. You're getting it the same way at the same time. This wick, its consequent encroachment, is below the rejection block. So it goes without saying, if I anticipate the price run from here and in here going down to this level, we have to gauge whether or not does it have the ability to trade below it. We only do so for the wick. But remember I was telling you, watch and see, does the bodies confirm that level? It did, right? And then what does it do? It returns back to an old area of inefficiency and that old 6 p.m. opening price. These are all old friends, folks. How many times have I talked about those key points? They're not a zone, some ambiguous, what do I pick as a price in a zone, a supply and demand zone? If the range that creates that supply and demand zone is 15 to 20 handles, or 12 handles, or 8 handles, which one of those levels are important to you as a trader? Which one are you going to use? How are you going to use it for the purposes of managing with a stop loss? See, that's why it's nonsensical. Now, I'm not saying some people can't say, well, if it's a demand zone, just use the highest level. Okay, well, that sounds pretty good. And then use a stop below it plus the range of the supply and demand zone, or some percentage of it, 1/4% of it, or 0.5% of it as a stop. Okay, that's a pretty good methodology. There's nothing wrong with that. But that ain't good enough for me. Like I want to know. I want to know that I can put a stop loss on this son of a bitch, and I'm going to be in there, and it's going to take a real move. They're going to have to really come at me to take me out, not just static price action, just normal volatility that is, oh, it stops me out. Like yesterday when I was live streaming, or was it Monday? I can't remember which one it was, but I showed my trade, and it went right up after I said it's probably going to go up there and knock it out and fill with repricing and send it down to where I was aiming for. It was like a go fuck you ICT in front of everybody. But that's all right. That's okay. I still beat his ass. And I'm going to beat you again tonight and tomorrow and next fucking week. It's going to be the same thing. It's fun. I'm having fun with it. It's sport. But it takes a real move, not just static randomness. Because if these things hold logic that's valid, then they will work more times than they fail. Not just 60% of the time, okay, but the majority of the time. The majority of them. You can't have this degree of precision, these elements that repeat over and over and over again without it having some control mechanism in play. It's only being allowed to do certain things. And it is a facade. It is nonsense to try to make an argument that the random buying and selling participants of buyers and sellers, traders, at these price points that we can see in advance. We can see this in advance. And then it books price this way. And it supports the underlying narrative that, okay, yeah, we moved from here down to there. The body supported it, said, okay, we're not closing below it, so it's rallying up. Did we take out the low? No. Did we go to the lower quadrant of that wick? No. They're still in play then. So if it's going up here, why is it going up? It's going back up to an order inefficiency, and it's reverting back to where the day started. The first print at 6 p.m. last night, New York local time. It crosses that again. I believe it would have done that even if that fair value gap wasn't there, and even if this wick wasn't there. That's something I would have expected. Regardless of anything else needing to be there, that's something I would expect, because from here going up higher, we don't have a gap here. We don't have a fair value gap there. We don't have a fair value gap there, but we have it there. So let's say that this wick here touched this candlestick's low. So there's no fair value gap that's shaded in pink. Okay. And let's say that wick didn't exist. Say the candlestick stopped up here. So the only information I would have is it's going up just to touch that 6 p.m. price again. And maybe bump, if this was the candle's body, this is your order block. So it might want to come back up and bump that again. But because we have the fair value gap and the 6 p.m. opening price, and we have this consequent encroachment, see how there's several layered things there. So right away, you know that it's reasonable to see it gravitate back to this, because that's the first real thing. Like that's a real level. If there's ever a question of what's the most likely level to trade to, when we're like when we're down here, I'm going to err on this side of going to that price level before the fair value gap, because what can fair value gaps do? They can stay open. Well, it sounds like you're making up bullshit. No, think about what I've been teaching you. If I'm short, if I'm bearish, and I see a fair value gap above price, market price, and if it goes up there, what do I want to see about that fair value gap? Do I want to see it close in? Fuck no, I don't want to. I've already told you that. I want to see the upper half of that, or some degree above the midpoint. I want to see it stay open. Why? Why do I want to see that? I want every fair value gap that's above my target when I'm short and I'm still in a trade. I want to see some of those fair value gaps stay open, because that's telling me this is so weak it can't even go back up there and reprice to it and then close it in. But because it does so here, it's okay. It doesn't change it. It doesn't strip the efficacy of this methodology. It just means that, well, we had the consequent encroachment here. We had the 6 p.m. price that acts just like a new day opening gap. But because there's no gap there, you just use the 6 p.m. opening price. You don't use the 5 p.m. You use the 6 p.m. Why? Because that's the first print. So the algorithm is going to go right back to that. If there's no gap, you're focusing on whatever the 6 p.m. There's no confusion there, is it? Is that complicated? No. Whatever that 6 p.m. price is, that's what you have annotated on your chart. You can annotate it any way you want. I just chose to use this. Again, I don't have this stuff on my chart. It's only for the purpose of teaching my son here. All these levels are in notation form, like writing it down on a little, like 9x5 yellow pamphlet, like little. I buy them from Office Depot. You get like 12 of them in a bundle. And every day I write the date, and I write down I'm looking for a sell program, looking for a buy program based on what I think it's likely to happen for the scenario. And then I write down any PV array that's going to be useful to me, what their price is, and the time. So I'm writing the time and the PV array with the price. So I have it in numeric format and labeling on my notepad, and my chart is completely naked. It's actually harder for me when I have all this stuff on the chart, because I end up spending more time talking or paying attention to the things I'm annotating for you as a student learning, and it distracts me from watching the actual price action. and especially over a live stream where I'm communicating, I'm teaching, I'm lecturing over something, and it kind of like takes my time and focus off of the real time candle. So this month of August, there's a lot of this type of stuff going on, but once we get through August and September, I'm just going to be talking about what the individual candles are happening at the moment and where they may gravitate to, and all this other stuff, this the supported commentary and things that I feel that's necessary as I go along. I wanted to be speaking only about every individual candle that's forming, so that way Caleb can watch and see what I'm thinking about every candlestick as it's forming. Which brings me up to the point of Al Brooks. I am not teaching Al Brooks stuff, and Al Brooks doesn't use any of this stuff either. Okay, um, I talked to Tom Hugard, who is a student and fan of Al Brooks, and he himself said that there's no comparison. It's totally, absolutely not the same thing. So that's the new flavor of the month, where they're saying now I took his stuff because Al Brooks apparently teaches reading price action one candle at a time. He ain't reading it like this. I'm a new language that everybody's learning. Okay, I'm not reinventing the wheel. I'm not transcribing and translating something somebody else did. This is a whole new science. We're evolving. Okay, we're way beyond everything else. But if you want to collect that $5 million, go through his stuff and see how everything I'm teaching ain't there. Do your best, because it's either is or there isn't, and there ain't nobody out there that's like me. But you go through all of these PD arrays. Anything that has a gap, and we were talking about this one over here, and then you have a gap right there. So you have an order block and a fair value gap. So if I ever have a fair value gap and an order block that's inside the range, meaning that, see the high of that candle, the down close candle, the black one, and you have this candle's low, that's basically the same range. This gap is inside of the bullish order block. So what am I going to refer to? Am I going to label it with the gap levels, or am I going to use the order block? I'm going to use the order block. Okay, so I'll use this range here, and what you do is you take this is how you do it. All right, so initially when we went down below the opening price on this bearish order block, changing the state of delivery, so that means your mind turns to, okay, the market's going to just keep offering lower prices. It's going to have little retracements. It's going to have little pops up higher, but they're going to be short-lived. They're going to be very controlled. They're going to be stunted. They won't be allowed to be really protracted to the upside. And then once it gets to a level that I'm teaching you that the market will refer to, which is a premium PD array, everyone that forms as the delivery is unfolding, they're salient too. But if there isn't an inefficiency in the price run going lower as it drops, whereas we end up creating one here, see that fair value gap that we've been talking about? That's the first fair value gap. This small little one in here, I wouldn't care so much about that. And the reason why is because it's still inside of the range of the order block that we extend over here. So this was used as a buy. We can see that here. And then when we went into a sell program, now the market's going to start going lower at this time. So the market goes up. We watch to see, does it want to get in this fair value gap? Remember what I was saying? When you watch the stream, you'll hear me say, I'm interested in this one. I want to see. I want to see. Why am I saying that? Because we're inside of a breaker. And it might be enough just to simply do that, trade into the breaker and not go up there. And it's actually a good thing for you to see where, trying to be very, very precise, and you having limit orders as your entry mechanism, you may not get a fill. So what do? You use the price delivery continuum theory. It means, okay, your time frame on a 1 minute basis here suggests that this is where you're trying to get in at. But if it starts to run without you, do you just say, fuck it, I'm going to start trading oil today then? I'm not thinking like that. I used to, as a 20-year-old, when I missed my only setup that I was anticipating, stalking and hunting. If it didn't give me a fill and it ran away without me, I was like, okay, I missed the whole thing. And I'm looking at moves that would be like $8,000 in the bond market. Okay, that's 8 full handles. They're trading $1,000 per handle. So to see a whole 100-point move, okay, just going one contract, that type of movement would literally be $1,000. It's $32.25, $31.25 per tick. Okay, so a full run like that. And if it's 8 of those, that's an $8,000 move. And a move like this in the bond, that means I'm probably missing out on $300, $400, less than $500. I've missed it. So therefore, I'm not interested in those $7,500 that could still be taking. In my mind, when I first started as a trader, and this is probably what most of you feel this way too. Oh, well, I need to know how to find these because I see it happening and then I miss the move. Or I chase it. I don't know when to get in. And I put my stop loss in the wrong place or I get scared out of it. I just keep losing. Even though I'm right, I know where it's going. I'm watching your live stream. You're pointing to where it's going and I'm taking trades, even though I tell you not to do that because you're learning fear, anxiety, because you don't know what I know. And just because I'm highlighting something doesn't guarantee it's going to happen. And if you're trying to pass funded accounts and trading 15 contracts because they say that you can afford to do so, you can still do it wrong and be right in your direction. That's very frustrating. And you're not going to blame yourself for breaking the rules. You're going to say, I'm an asshole and this stuff doesn't work. But you sit down with me and we'll see that you didn't listen. I've had students that try to do that shit. Show me your logbook. Show me what you've been doing. Show me your trade entries and show me why you got into that fucking trade. As soon as that question comes up, the conversation ends. Because they know they don't listen. Just like I didn't listen. When I first started codifying rules around these ideas, I tried to make excuses for, well, I'm going to try to be outperforming these rules. I'm better than this. Okay. And I never established a baseline to trust initially. So I had to force myself to go through that stuff. And you have to do the same thing. And I'm forcing Caleb to do that. As you can see, he's not getting an easy way. He's getting the woodshed shit just like all of you do. There's a lot of things. And you have to figure out where your model is in all of it. And you don't need to have every aspect of what's available to me as the creator of this stuff. You just have to have little compartmentalized segments of price movement that makes sense to you, that's logical, it's reasonable to anticipate forming at the time of day that it should behave that way. So at this point, we start looking for every possible reason for price to trade down. Well, this area here with the order block, it's in close proximity to where the start of the move would be. So are you going to have that on your chart and have all that much interest to it? No. You do want to see it trade below it, which it does here. So at that point, I'm not interested in that one. So what's below that? We have this gap right in here, which was already used. Yes. Watch. This is all trading inside the range. Okay. I'm going to change the color of this a little bit. Well, actually, a lot wouldn't be. This is your gap here, which it trades down to it here. Why is it trading with that little, I call it a mohawk, where it colors outside the line? Why is it doing that? Because there's an overlap of that candle's wick and that candle's body. So that's a balanced price range. So it's just validating that. It just stops it like a you will not pass. You cannot go any further. Okay, and that's why that little mohawk stops there. 90% of the mohawks that I anticipate where the market trades us outside of a PD array, I can see them. I can anticipate them. There's logic behind them. I'm not going to teach you all that stuff, and that part won't be in the book. Okay, so I want you to know that there's a lot of things I'm not going to teach because I'm just not going to do it. And I don't give a fuck who asks and twists my arm and calls me before them. I am not teaching it. Done. Okay, so you can see how the market uses this fair value gap, which becomes what now? Let's say that you are a fan of the concepts that I'm teaching and you really are resonating with them. And maybe some of the things I'm teaching, it just doesn't jive with you. You're like, I can see when you're pulling it up, but I wouldn't have saw that. Okay, don't beat yourself up about it. What are you noticing in price action? What do you see? Because when last year on Twitter Spaces, when I was teaching the concept of inversion fair value gap, not every fair value gap becomes an inversion fair value gap, by the way. Okay, and there's a young man out there that's very overzealous about inversion fair value gaps, and he almost implies that he created himself. But I understand your enthusiasm and you're overzealous, but not every fair value gap becomes an inversion fair value gap. Okay, but if you didn't know the logic that I'm teaching today about the wicks, okay, if I didn't teach that and you didn't know anything about it, and there wasn't this gap here in the pink, say that didn't exist in this price time right here, and there wasn't a 6 p.m. opening price that we would reference anyway, and say that was the case, and that we still started retracing here, what would we be using then? That gap extended over becomes what? Inversion fair value gap. And what would we want to see with that logic, ICT? Tell me something that you didn't change and change the logic around it. It's got to be consistent, because if it's changing, you're bullshitting everybody. And I'm getting lucky over live price action. That's what it sounds like, okay? To some of you, that's exactly what you think. But listen what I have said many, many times. If this is the gap here to here, extend it over, look at that little square right there. That's the midpoint. That's consequent encroachment of what? That gap that is now going to be expected to be what? An inversion fair value gap. Do we want the inversion fair value gaps to close in entirely? In other words, if it trades up to the low of it, do we want to see it trade all the way up to the top and touch that? No. Why? Because every inefficiency, if I'm short and it's trading back up into it, I want to see the upper half or some portion of the upper half of it stay open. I want to see that. Why? Because I've been talking about it since last week. Every array that is an inefficiency, if it's a gap, if it can't fill the gap entirely, and I'm short, and it trades up here and leaves a portion of it open, that is telling you the clearest, loudest way to say this market is not going up. It's weak, so start looking for lower targets. It's going to go lower. Is that a hard, complicated thing? No. Am I changing the theory around it? No. Is it manifesting itself here? Yep. So it doesn't matter if you didn't have the 6 p.m. It doesn't matter if you didn't have this fair value gap. And it doesn't matter if you had this wick here. If you didn't have any of those things, once it started coming down and we're in a sell program, I would be extending these things over here. That's what I use with market maker sell and buy models. That's how you're using them. You go back through the range. Okay, back on baby pips. I was going to start leading myself into some of these lectures, but not to the degree I ended up doing with the paid mentorship. I never intended to teach all that stuff, but it became fun, revealing more and more and more, and I got addicted to everybody's astonishment, and I got whipped up in the frenzy of it, and it was fun. But just know that there's a limit to how far I'm going to go with it all, but there's a lot more that I'm going to share. But in here, going back from here to that low, I did a lecture on baby pips. It's called Trading Inside the Range. And I started to teach the beginning elements to some of these principles. And at the end of that lecture, I actually had anxiety about having done it because I didn't feel comfortable revealing it. I didn't feel comfortable doing it. And it took time, putting my toe in the water to see what would happen if I revealed a little bit more and revealed a little bit more and revealed a little bit more. And over the years, it's a lot out there now, but I had to make sure that I have a language that I can lean on as this is what I'm teaching. This is what I'm showcasing. This is that. Okay. But there's nothing else out there in retail that this is what it's replicating or duplicating or borrowing the logic of. And believe me, $5 million is a nice chunk of change. And if it was possible to be able to say that this stuff is renamed, rebranded, called something different, thousands of you would have came forward with it. And it's not happened. So there you go. There's your obvious testimony that anybody that says that are just parroting other people, or they're trying to sell something and they're trying to just take the attention and the momentum around what it is I'm giving to the community because they want to sell their bullshit. Hey, I understand groceries are expensive, but you go back through all that range and you start looking for where it acted as support, where it was discount, where it sprung price higher like a trampoline. When you start going down, because you're in a sell program, why? Because he has to change the state of delivery here. Everything starts seeking lower prices. It's not just simply, well, here's the support. Let's just go there. That's not enough for me. Because how will you, if you're here and you expect it to trade down, it's not going to do that in one shot. Can it do it? Sure, it could. It could have a big candle just fall out of bed and go down there. But you won't be able to trade those kind of environments anyway, just like this kind of day is, or this kind of individual candlestick. You can't trade the PPI and the CPI number. You can't enter those candlesticks. And many of you probably already discovered that you can't even use the paper trading platform on TradingView when you have these big reports because they're lagging. Like there's no, you can't even do anything with it. So, which is kind of a good thing because that keeps a lot of the fakes out there from saying, look, I did 50 contracts on this on gold, and look where my fill was. You didn't get filled on that shit. So you go back through all of this price range, and then you have this gap here. So let's make a notation of that one. You have that, and look where the bodies are stopping in there. See that? Yeah, we go up into that fair value gap because it's there. So every new array that forms, that means any short-term high, any bearish up-close candle, which is an order block, any gap, like a fair value gap, all of them have to be referenced. My attention, every time it forms a new one in the new sell program, they're most important to me. If they agree and they converge with something inside of the buy side of the curve, which means while it was going up, if it matches, then there's going to be a lot of weight associated with that, and I expect price to remain heavy. You ever notice when I'm talking about in trades where I'll comment and say, I'll type it out and say, I want to see speed and distance, or I want to see large range candles. Those are indications in my mind because I'm seeing things like this where, okay, there's a fair value gap over here that acted as something bullish. How do we know that? Because look what it did here. Traded down to it here and then repelled price higher. Okay, that's not support and resistance. It's the logic that inefficiency stayed open. You see that? It didn't completely come down to that candle's low or at that high that candle, which is the low of that fair value gap. That's what you want to see. If you're going to try to buy a fair value gap and the market's bullish and you're right in where you think the market's going to trade to, you're buying the fair value gaps high or something just above the consequent encroachment because the likelihood of you getting it consequent encroachment or just below it and being filled is very small. Can it happen? Absolutely. If you do, you'll have one of the best fucking entries. And that's the one you can go on Instagram, go on Facebook, put advertisements out and say, I'm selling a course. Look at this. I learned this bullshit. That's the ones everybody wants a dog and pony show. But it's a steady diet, even in my own hands. I don't get those types of fills. So I have to use a very low threshold of entry. That means I'm going to use the easiest barrier to break through. I'm going to use the high of a fair value gap that's going to act as support for me. I'm going to buy that discount array at the high of the fair value gap or one tick below the highest part of it. And I'm going to try to get my largest portion on there. If it trades to the midpoint of a fair value gap and I'm bullish, I'll add on another portion and I'm not afraid of it. If it leaves that fair value gap and comes back down one more time, touches the consequent encroachment, I will add to that trade again. And if you look at my trade examples, they're all over on Twitter. The ones that don't have, I put songs in there because I love music. Okay, and the trades that I'm taking at the time, I like to use a song that I was listening to, and because I would take the trade and condense it by speed because you only had to have, I think it was like 1 minute and something over there on Twitter. It used to be that was the timeline I had to, or time limit it had on the videos. I thought I was safe by using the music over there, but I don't sell like engagements over there. Like I didn't make money by having people watch what I do. Like I didn't monetize that over there. But the artists would obviously, put copyrights against me and they take the videos down. That's why I told everybody when I was on Twitter, I said, if you like these things, download them because I was always getting suspended on Twitter last year and year prior because the artist or the management company that holds the rights for their songs, they were making Twitter or X now remove the video because it had a song in it. To me, that's a dick move because I'm not even monetizing it. Like I'm literally giving the credit to the author of the song and I'm a fan of it. And it's just me just doing something with no money. I'm not making money off of that, but I get it. I understand. But the rights holder or the artist was having a lot of those videos taken down. I haven't been on Twitter. I haven't been on X. I haven't even logged in. I don't even know what's going on. I don't know if the account's still active or not. But I know last year I was telling everybody that they were putting copyrights against me, and they were literally removing the videos. I wasn't deleting trade execution videos. I wasn't trying to hide something. I told everybody to download them. So, but if you have them, or if you have the ones that's still up there, if you look at them, you'll see some of the things I'm talking about here. That's what I'm using when I'm trading. When I'm pyramiding entries, for instance, let's just say that I wanted to sell short when we ran above these highs in here and traded right in there as a bold face bullish candle, selling short right there. That is a turtle soup. Why? Because it's clearing these highs, it's clearing this high, and it's trading into a premium array. And it's been going up since last week. So it's reasonable to anticipate it to do what? Retrace. And challenge what? The consequent encroachment of that wick, because it didn't do it here. So we've pushed and pushed and pushed and pushed and pushed. We had two real high impact news drivers yesterday and today. It's Wednesday, hump day. We're in here reaching for a market level that I gave to you yesterday, and we watched it break down. I would not have been filled on any entry here at all, because I would have had a limit order right at this candle's high plus one tick. That's how I would have used it. And you watch and see me in the live stream here. I'll say, I'm interested. I'm watching this to see if it wants to get up in here, because I'm not going to execute today. Not yet. I will be executing in front of you. You want to see this stuff being pushed on a button? I'm going to do that because I want my son to see how to enter orders, how to place a stop, when to move the stop. I'm going to be doing all that stuff. I'm not afraid of that stuff, okay? But I'm not going to be doing it as a service. Okay? I'm not going to be out here doing a dog and pony show every single day, because every time Dick and Harry has a $5 mentorship is going to duplicate what I'm doing. They're going to literally say what I'm in my charts doing, and anybody that's not watching me in another world, third world nation, they're going to be like, this guy's smart, but all they're doing is parroting off of what I'm doing. So that's why I'll be using the 15-second chart, because even though there's the smallest delay in latency between me doing this live and you getting it, that's the way I'm going to combat that. That's the only way I can combat it, because everybody wants to duplicate and copy everyone that's hot and popular. And this old man still got some spice in this stuff. So everybody that wants to rip somebody off, they're doing it mostly off of me. But you'll see all the entries and stuff. But I have to give you the foundations, because it's really meant for my son. And then when I start showing him how to enter the orders, where I put the limit order in, where I place my stop loss, and yes, it's important to use a stop loss, not like put a trade on, hope it moves around, and then put a stop loss on, screenshot it when it's in profit. No. Look at my executions. I'm picking a stop loss, and look how nice they are. Those stop losses have logic behind them, just like I'm explaining all these things in here. They have very specific elements that cannot be explained in a 5-minute sentence or video. There's so many supporting things that have to go along with everything that makes these things work, which is why I tell everybody it's going to be expensive. You want it to be fast and easy, and I wish there was a way to do that. I wish there was a way to do that. But you can see that it's not something that is explained right away in one statement, and you have everything to know about it, and you don't ever need to revisit or even worry about practicing studying it. You now know what an order block is, because guess what? It's the opening price. If it's multiple candles, just find the opening price of the up-close candles. That's the change in the state of delivery. They're going to write a book. They can't trade it. They won't be able to do it. They won't even be able to sit over a live price action and explain to you why it's going to happen. But I'm telling you how to do this stuff, so that way, once you learn it and you digest all the information I'm supplying to you, because again, I'm not talking to the guys on Twitter. I'm not talking to guys on Instagram. I'm not talking to other people on YouTube. I'm talking to my son. So I want him to know everything. I don't want to say to him, I'm going to give you a condensed version and filter out a lot of the essential parts that's really going to make it easier for you when you have adversities trying to use it. You're going to know it like the back of your hand. That's how I teach. I'm teaching my children how to know it like I know it. Everybody out there that has my logo in their shit and trying to sell the idea that they know how to use this information, sometimes they can use it. Sometimes they can't. When they talk about certain subject matter that I know they don't know because I haven't fully taught it, that's what gets on my skin. But that's also the reason why I'm teaching in great lengths, because I'm talking to my children. I want them to know every aspect. That means if you listen to the dialogue of everything I'm saying, I'm giving you what you don't realize is going to be a problem. You don't know yet because the question didn't come up in your development or your testing of it yet. You haven't even messed around with it in live price action. You haven't investigated any of this yet. You're just hearing me talk about certain things. And you think, well, I understand how to do that. No, you don't. You don't know how to do it. You just know what I said. And that's not the same as going out and being able to understand how to read it in the new price action that's going to form. So when I get questions saying, how do I know what fair value gap to use? I'm teaching that to you here today. How do I know how to trade the market maker sell? Can you talk about market maker sell models and buy models? Everything I talk about is part of that, even if I don't even mention it. If I never mention those terms, market maker sell model, market maker buy model, every aspect of what I trade off of is part of either a market maker sell or a market maker buy model. It's always there. But because when I taught that lesson, go into the lectures, okay? They're on the mentorship videos. Go in the playlist, go into the 2017 mentorship, and you'll see me talk about market maker buy models and sell models. And then I talk about the buy side of the curve. And then I talk about the sell side of the curve, okay? When the buy side of the curve is unfolding, that means it's buy side delivery. That means down close candles or fair value gaps that get traded down into should spring trampoline push price higher. Once we turn to a point where it should reverse or could reverse, which is in essence a turtle soup environment, turtle soup is a reversal mechanism. This is a change in the state of delivery, turtle soup. And then you have a turtle soup that is an entry mechanism that's part of an existing or unfolding sell or buy program. What does that mean? What does that mean? That means that this is a change in a directional price run that's going to most likely be sustained for a session or day or longer. The turtle soup aspect is that we're taking out the liquidity above this high and all these highs here. So the buy stops that's resting in here for anyone that wants to go short or be short, if it's not there, it's definitely above there. But how far, ICT? Well, that's the reason why you want to have these new week opening gaps and new day opening gaps on your chart. 5 weeks for new week opening gaps, 5 days for new day opening gaps. You are welcome, and I encourage you, if you can organize your chart sufficiently, to do more than that. But as a baseline to start with, you'll see many really, really nice trade setups using that criteria. 5 for end dogs, 5 days for end dogs, basically, and then 5 weeks for new week opening gaps. End logs. It doesn't sound right. End dog sounds cool. It's like, yeah, well, what's up? End dog, yeah, what's up? Here's end dog, give me 5, bro. Yeah, that's cool. End wog kind of sounds like an Ewok. Fucking, something wrong with that guy. Something wrong with him. But the information that it gives you, okay, that information is gold, because the markets are going to do what with them? They're going to act as magnets. So if you have one element of a turtle soup that is a change in the state of delivery that causes a directional change that's going to be sustained, okay, that's a reversal pattern, then you have turtle soups that are entry techniques that are part of an existing price run that's still yet to be completed. Meaning that we can look at all the run from here down to this low here, and anything that sees a short-term high pierced, not just by the wicks, not just by the wicks, the bodies. That's why I'm not teaching Linda Raschke and Larry Connor's turtle soup. This right here is not that pattern either. Go look at it. I'll tell you in a very simplistic way. The book Street Smarts has a pattern. There's 2 of them. There's turtle soup and there's turtle soup plus 1. And all it is they look for a 20-day high, and if it trades above a 20-day high, they will fade that and go short. And they have a very short profit objective. To me, it's infantile. It really doesn't make any sense. But if for short-term trading, like getting in, getting out, real easy, no-brainer type things, if it's going to fail, at a 20-day high or low. And I don't trade this, folks. Like, I don't trade that pattern. There's got to be something else. But for that book, that's all they had. And then there's 20 days plus one, which is basically the same thing, just one more day. And reverse it. They look at an old 20-day. What's the lowest low in the last 20 days? If it goes below that, they're going to buy that. Well, that's not enough information for me. And just as well as they try to capitalize with the name, which is really clever, they try to capitalize on the low hit strike rate of the turtle traders that Richard Dennis trained, because he used that 20-day breakout system. They would buy 20-day highs, and when it was a long-term trend, it would just keep on going, and they would make their money there. But they had a lot of losing trades that the 20-day high breakout would fail, and it would go back into the range and stop them out. So they had a very, very low strike rate. If my memory serves me right, it was less than 38% accurate. So how many times are you going to stay with a trading system that has that low of a success rate? Chances are you're not. You all think you're going to get 198% and all that shit. That's not going to happen. For your first couple years, you should be tickled to death if you're less than 50% accurate and you're still profitable. That's a huge Olympic win, because most people can't even get that. You can be profitable and have a very low strike rate, but it takes the mindset of understanding that it's about making money. It's about staying solvent. It's about following rules and not blowing the account. But it's so easy to go on tilt and lose sight of what it is you're trying to do, and lose sight of these building blocks, these stepping stones to, okay, well, this is what I'm going to use, and if that one transaction fails, it's okay. I'm going to go back tomorrow, and I'm going to wait for these things to be there again, and I'm not risking a lot. So Caleb can do every execution when he starts trading, but he can't risk more than 1%. But with turtle soups that are part of an existing price run, not a change in a direction like we have here, you have turtle soup entry mechanisms for your trades. Well, can you think of one without having to go on to any detail further right at this moment? I want you to think about it for a second. What did you learn from me thus far? Maybe in this mentorship this year, maybe it's in other lectures and things I've had on the YouTube channel, or maybe I taught about it in a Twitter space when I was on Twitter. What concept do you think would be one example of a turtle soup that's an entry technique in a trade that a existing trend or momentum or seller buy program is underway with? Can you think about that? What do you think it is? Institutional order for entry drill. Ooh, how about that? We have that in the form of, we have an old high here. See that? Why is this high being utilized anyway? Because it's a fair value gap. Every time I go into a short on a fair value gap, or if I go long on a fair value gap, my mind is I'm trading an inefficiency with a mechanism of entering with a turtle soup. So I'm buying below an old low. So if I'm, like, for instance, I didn't take this trade, so just for full disclosure. Let's say that I was seeing this at the time, okay? And I want to take a trade, and I want to be a buyer. I'm going to use this candlestick here, the high. Why am I using that? Remember what I was talking about earlier? Look at the wick. It's overlapping inside the top end of that candlestick. That makes that small little, I'm going to have to zoom in. I know you guys can zoom in on your YouTube, but I want to really get in here and kind of give you the brass tacks to this. Because if I'm going to teach it right. So we have this candlestick run up, and then we have this portion where we opened and traded down. You might look at this and say, well, why don't you have this and this? That's something entirely different. This is a normal run-of-the-mill ICT fair value gap. This is what you get when you watch one video and you think you know everything about it. You don't. Just like when I teach a volume imbalance, okay? If I teach you to use a volume imbalance when there's a fair value gap in formation, that means that there's a separation between one candle body and another candle's body that is inside of the fair value gap. We don't have that here. But what do we have? We have an overlapping of this candle's high. It's all body. And then we open, we trade down. It overlaps this little portion in here. But there's no wick there. You see that? Big telltale sign. What's occurring there? It's flush and one little tap down. So, and I highlight this, I'm highlighting that. You're thinking, I guarantee you, I probably got comments right now, and they're probably going to go in there and delete it now. They use my most recent post on my community post. You're drawing the fair value gap wrong. No, you're not. You don't know what the fuck you're talking about. This is how I would classify this inefficiency. But I have to encapsulate it here because this is a balanced price range between this low and that candle's high. That is a PD array that you've never learned before. It's the first time I'm introducing it. Just like when I introduced the inception of the volume imbalance, when there's a gap, the fair value gap, you have to incorporate that because that's the real range of that inefficiency. This inefficiency here, you have to refer to that as well. Notice it doesn't even get down into that gap below right there where it was like this. There's nothing there. It's just a gap that stayed open. Yeah, wonderful. But that's not the narrative. The narrative is you have a balanced price range here inside of a fair value gap. So that's why the market goes down to that level there and sends it higher. So in case you were watching me earlier explain this, because I was in a rant, you were probably thinking, oh, this doesn't make any sense. No, you don't know all the details. This is why you can't get a 5-minute trainer. You can't get a dollar mentorship mentor telling you this stuff. They don't know. They don't know. Okay, I promise you, they don't know. And if you're not learning from me, you're getting watered down bullshit. You're not getting the real details, and it ain't gonna work for you. So extending that over here, that's the range. But if you have this candlestick here for that gap from here to here, see that? That gap is part of the sell program. It's formed as it dropped. So those are going to always be the most important ones. I'm watching that because what I'm watching is I want to see, does it converge and agree with something that's over here that formed as a basis for taking a trade. Okay, let's say that we did not have this gap again, and say we didn't have this gap and this gap. What over here would be in agreement with this 6 o'clock time? Remember yesterday at 6 p.m. we have to annotate that either with the new day opening gap if there's a distinction between the 5 p.m. closing price and the 6 p.m. opening price, because there's that 1 hour gap in price and trading. They don't trade between 5 and 6 o'clock. We always annotate that as a new day opening gap. But if the 5 p.m. closing price or settlement price is the same as the opening price at 6 p.m., all we do is draw a single line, and you can label it whatever you want. If that's all we had there, and we didn't have the inefficiency in this form of this gap here, and we didn't have that one here, what else would be there? And let's say we didn't have this wick here. Say we didn't have that. What else, if it was retracing up, what else would I lean on? I would use this, obviously, but it could trade through them. Remember, it can spike. It can cause candlesticks like it did here to have wicks. What is it doing? Look to the left. It's part of the buy side of the curve. What do you see? Don't look at my cursor. I'm not putting my cursor on it to give you any help. I want you to try to think about it and tell me what you see. Obviously, I can't see. I can't hear you. But isn't this a wick? See that? So what do you do at wicks like that? Ignore them? Oh, it's a doji ICT. You're reinventing. Bullshit. Come on, Steve Nielsen, guys. Watch this. Steve Nielsen's the candlestick god. Puny god. Here's the halfway point of that wick. That's pretty fucking random, isn't it? It went right to that as well. And even if you didn't have all these other things, if this candlestick went up and stopped short of that, that means I absolutely know with a great deal of confidence that the next candle, when it opens, I want to trade into the body of this candle. And as soon as it does that, that's going to be treated as a bearish order block. Not because it's an up-close candle, but I'm trading it because it's inside of the range of that candlestick. Remember I was telling you many times in rants, many times on Twitter Spaces, I can trade inside of an order block before anybody else would recognize it as an order block, or they want to call it a supply or demand zone. I'm trading inside of the candlestick that will later on be obvious in hindsight to someone else. Oh, That's an order block. But you were entering before the order block. How do you know how to do that, ICT? You're getting all the answers in 2024, baby. All you gotta do is show up. Just take some fucking notes. All the information is being disseminated to you like a fire hose. Okay? Don't complain when it rips your fucking face off. Just be thankful you're getting a drink. That wick, that consequent encroachment, extended on over here. So how many things are you seeing converging right there? Lots. That tells you that this retracement here is going to send price lower. That's why I said I want to see it now go down into, go back and listen to the stream. It's going to be there. I can't change it. We're going to look at it and see if it can reach down to the lower quadrant. And it gravitates from here down to that. Then what does it do? It returns back to the midpoint, consequent encroachment of that wick. See how that works? Boom. Oh, this is classic support resistance. No, it's not. It's not supply and demand. It's technical science. Anton Creel. It's technical science, baby. You know he's fucking watching these videos. If someone tells you that they can tell you what's going to happen in intraday charts, run away from them. They're a con man. They can't do it. They're not. Well, what do you do with us? It's a whole bunch of us doing it. Market trades out to that and then trades down to the low and explores below the low, which is what we have here. Okay. Now, with that said, I've exhausted everything to do with the buy side of the curve over here. Then the rest of it is just simply using the rejection block and the actual low. Okay, so we went through all the PD arrays from that high going backwards inside the range. So that's trading inside the range. So my question to you is, out of all those things there, which element is your multiplier? What's the one that you see right now? I'm not saying that you can go out and take a trade with it. It doesn't mean that you can go out there right now in front of the whole world, live stream, and do entries with it. That's not realistic for you to expect that. I wouldn't expect that out of you. But which one did you see? Chances are you didn't see all that. You might have saw one or two, maybe three things. But which one did you easily see without me making special attention to it? Or if you're brand new, out of all the ones I just described, the one that makes most sense to you right now, because that's where you start. That's your beginning point. That's the thing that you look for in price action. And when it's not there, you do nothing. Until you get more understanding and more learning, more experience watching me call this stuff over live price action, then you'll see, oh, I started with a so-and-so PD array, and that was where I first started learning. But then I really fell in love with this particular PD array. And I'm leaving it blank so that way it gives you the flexibility and allow your personality, because it's essential for that to be there. I don't want to force you into this is the only way to do it. But Caleb's going to have to learn all these other ones in addition to just simply a fair value gap, because it supports holding on to a trade. ICT, can you talk about how to hold on to a trade? Because I get shaken out of trades, and I have a target, but I get scared and I get taken out of it because I'll close a trade and then it goes to my target. Well, you have to know your range. Up here, well, if it's going to go lower, where's it going to go? To that low is where sell side. But before we go there, we have all kinds of opportunities, which is what I just outlined. We don't need it to go below that low or even trade to that low to be profitable. Any one of these PD arrays that we outlined in the rejection block in that low and in this consequent encroachment on that wick, that could have been a partial, that could have been a terminus for your trade. And guess what? That doesn't mean that you're stupid. It doesn't mean that you're not good at trading because you didn't hold for all this run down here. You have to have a starting point. Like my son, Caleb. He has to have some kind of measurable expected range to operate in at around a specific time of day and do the same things every single day and not worry about what's going on outside the boundaries and parameters that entails, because you're always going to find an excuse to feel like you didn't do enough, you didn't make enough, you didn't get in at the best price, you didn't hold for the best price and get out at the best price. Like that's something that you're going to be plagued with the rest of your life. As someone that's been doing this for 30 plus years, I don't like my exits. I want them to be perfect. I want them to be better than they are. And you see what I do with my executions. When I show them an entry, manage the whole show, you see that. It's pretty good. And if I can go back in time and say that to my younger self at 20-some years old, here's how you're going to know how to trade later on. I'd be like, if I can just do that, I'm happy. But that won't be true when you get to that point because you're like, I want to go beyond this. So you're always striving, at least for me, I'm always striving for perfection, knowing it's going to evade me, but I'm going in the right direction. I'm not trying to go the other way. I'm trying to refine and make it better. And usually that's done by doing little and less. Not more of the same stuff. It's just doing less of the things that I try to do. And that's when I don't try to beat my own systems. When I don't do that, I have the better exits. And when I try to finesse certain things, because I think I've woke up on a better side of the bed. I think I'm going to really do a stunner today. My exits aren't as fashionable as other times. So I don't know if that means anything to you, but I just learned that that's what I've observed in my own exits, my own strategies and such. But when the market creates this fair value gap, this high right here, okay, let me take this off for now. Let me take all this stuff off for now. And what I'm saying is, conceptually, from this candle's opening price all the way down to here, and we'll just use, we'll replicate. This is also a targeting strategy, so you can write this in your notes too. It'll be in the book in case you don't fully get it here. Because I have a wick, I'm grading that price swing, or that range, if you will. We have a quadrant. So if we have this, and it's 1/4 of that range, I'm going to ballpark another quarter range projection lower. And it's about right there. I'm looking at this here to here. Okay, that's what I'm doing right there. And if I want to, I can do this. That would be negative 0.25. What happened here? I did it wrong. There you go. That's pretty good. That's pretty close for eyeballing it for a 52-year-old with a prescription updated. My eyeglass, I had my eyeglasses prescription checked, and I discovered that I have gone up 2 prescriptions, and that's the biggest jump I've had with my vision in my whole life. So that's a little disconcerting. But the range here that I just projected, that's a good target right there. So if we're going to go below this low, how can you determine a very low threshold, very easy, low-hanging fruit objective? If you want to try to trade for something lower than that low, how can you do it? Well, what is that low part of? Is it part of a range like this wick, or is it part of the range from this high down to that low? If it's going to go below that for the express purposes of using the wick for your target, or the range high down to that low. If it's going to go below that low for seeking liquidity, okay, let me do this. Okay, we just did the measurement on that anchored right here. We're going to draw this up to that high. And you can see it's on that low. The same aspect of what we were trying to measure for projections. We can do that same thing with that range here. And whatever the 20% or 25% or a quarter of that range here, we can project lower. That's the lowest threshold. That's the easiest. If it's going to go below an old low, how far can it go below the old low? And you can get that measured by that. So you have the low of the actual candle, like this. See that? That's the low. That's where we were targeting. And anything below that would be liquidity. What kind of liquidity? Sell side. And if you're using the range, and you're going to be using range targeting, this range is the high to that low. And this is 1/4 of the range projected below that low. That takes us to this level here. And that's a pretty good target. I mean, you won't get all that, but that's okay. I mean, that's usually like if you're not using standard deviations. Now, standard deviations are taught in the mentorship videos on the 2017 mentorship playlists. I don't recall off the top of my head because I'm 52. I'm having a Biden moment right now when it comes to think about where the content was per month. I don't recall what that was because it's been a little bit of time since then. But where I'm teaching standard deviations, that is the closest thing that I'm going to reveal to the public on how to get really, really, really tight precision grouping with your exits that are closest to the highs and closest to the lows. But if you want something that's very simple, doesn't take a whole lot of work, it's really off the cuff quick, it's just what I just showed you here. Okay, and if you just rewind this portion again, it'll make perfect sense to you. The only thing you're doing is trying to get 1/4 of the range beyond the low or high that you're trying to trade for. So this is what we were aiming for, and that's the excuse for reaching for something in here or in here, and being content with not getting anything beyond that. And that's going to be a skill set for you to acquire, where I made enough money, and you have to come to terms with whatever that is. And over time, you're going to see that that's more than plenty, but it won't feel like that when you're first learning. So back to this right here. For turtle soups that are part of an existing price run, anytime you're trading in a fair value gap, you're literally trading a turtle soup. You're trading above and going short an old high, which is this candle's high. So it's not support and resistance that we're trading. We're trading with the express purposes that there's an absence of buyers that's been afforded any opportunity to be a buyer above this candle's high. That's essentially what my fair value gap is doing. So let's do this.